How's everybody doing? Good. I want to welcome you today to our 7th annual UHY construction update. My name is John Gallo. I'm a principal in our Farmington Hills office, and this is a great crowd. There's so many faces I haven't seen in many, many years, to new faces that I'm meeting for the first time today. So I really appreciate everybody coming out. Really do. What I'd like to do first is just kind of run through how the agenda is going to go and what's going to play out. I'd like you to reference the handout that's on your table. So we're just going to go to, if you could flip to page 3. This is kind of the agenda for the morning. Obviously, it's me, John Gallo. And then we're going to talk, the first half of the morning is going to be a little bit of financial statement and some tax. Nothing too technical. We're going to keep it light, but at least give you some ideas that you can think about when you go back to your businesses and you're looking at your year-end, some tax planning strategies. Then we're going to take a short 15-minute break, and we have to be on time. So Jessica, my assistant here, is very particular about keeping us on time, and that's a good thing. So if we could, when we do our break, we need to come back very promptly. The second half, I'm really, really excited about. We have some outside speakers. One of the hot things that is in the buzz in the media is opportunity zones, and the opportunity that they arrive. So we have 2 speakers, one from UHY, John Shoemaker. I haven't seen him yet, but I know Gina will be here to speak on opportunity zones. And then after that, we have a construction outlook with Mary Lefevre and her team that is going to be talking about the economy and the things that are going on in the Detroit market. If you flip to page 4, just some administrative items. If you need CPE or CE, Jessica can help you at the front desk. If you don't know what CPE is, you probably don't need it. In the back, there's a feedback that's really, really important, especially in the box where you can write things in. We truly look at that and use it to plan for next year on the different things that you guys are looking for and what we could do better for you. So if you could make sure you fill that out at the end of the seminar, we'd appreciate it. Questions, there'll be some pages in the handout where you can jot down questions or take notes. But at the end of each session, we'll have a quick Q&A session. But please, if you still have a question, reach out to us. I'll be here. We're going to answer every question that you have, one way or the other. If we can't answer it today, we'll get back to you. All the slides that you're going to see today, a few days after the event, they're going to be available online. So you can download them and have them if you like, as well as the video. So if I do such an outstanding job, you want to watch me again, you can actually click on the video and watch this whole presentation one more time. Page 6. It's a little bit about UHY and our firm. If some of you are a little bit more seasoned, you'll know that before UHY we were Fulmer Rejevitz, and we're actually celebrating, I think, the napkins and some other things. We're celebrating our 50th anniversary this year. I think that's really a big deal. In fact, our founder, Mr. Fulmer's here today, which I wasn't expecting. So I think that's really great. We've been around for 50 years. Hopefully we'll be going for another 50. One of the stories I wanted to tell you about our firm was, and I did not expect him to be here, so I don't even know if he remembers the story, but when I was really young at the firm and started, which was years ago, we were at a mixer, and I was standing next to Gordon, and this young entrepreneur came up. We'll just say he was very, very confident in himself. And he asked Gordon, "What do you do?" And Gordon looked at him and says, "I make millionaires." And he turned. And I thought that was the coolest thing ever. And I'm like, wow, he didn't even say he's a CPA or whatever. So he got the guy's attention. He comes back up to Gordon and says, no, really, what do you do? And he said, I'm a business advisor. And again, I thought, wow, he never even said, we do tax returns, we do financial statements. Now I was a young guy right out of school, so I didn't even, for me, I was like, oh, we prepare tax returns and financial statements. But over the years, I've learned from Mr. Fulmer that business advising is really what we bring to the table to our clients. And it's the business advising part that really makes us business partners with all our clients. So over the years, I've learned so many things from Gordon, you can't even imagine. I give him all the credit that I have today. Page 7. If you do want to go into a detailed list, at the bottom of page 7, that's a laundry list of services that we do for construction clients. It's pretty detailed. Page 8 is just, it shows all of our U.S. locations that we now have as part of UHY, but we're also part of a global network, and you can see all the countries where we have UHY offices around the world. Pretty impressive. And then if you flip farther back, you'll see the bios of all the speakers. Page 10 is me. To give you some background on everyone and their history. Page 19 is our Construction Insider. This is a quarterly newsletter that we send out pretty much every quarter. We try to at least. If you don't receive this via email, please let Jessica know, and we want to get you on our list so that you're receiving these as well as other newsworthy items from UHY. So, we try and make it as timely as we can, insightful. So here's just our last issue, and if you don't have that and you're not on our mailing list, please get with Jessica. And then page 26, that's the feedback sheet that we like you to fill out. And again, the additional comments in the box really are what are most important to us because it helps us make a better seminar going forward. So with that, I'm going to go back to the schedule of events, the agenda, and our first speaker, which is a UHY alumni, and she now works for First State Bank, or Flagstar Bank, Flagstar Bank. Diane Menzo is going to talk about revenue recognition and lease accounting. Oh, right there.
Hi, everyone. Happy to be here to talk to all of you. John said we're going to keep all of this light. I'm not sure how light I can make revenue recognition. So full disclosure, I will do as best that I can, but I'm sorry if I put any of you to sleep. So today, first, we're going to start with an audience poll to make sure you guys are all awake and alive. So if you guys want to pull out your smartphones, if you want to participate, to get those ready. The revenue recognition standard, we'll talk about the effective dates, implementation methods, and talk about the 5-step model. And the lease standard, also effective dates, implementation method, and then some of the changes between the old and new standard, and then some updates that have happened in the last year in both of these standards. So we're going to start with the poll. So if you go to www.menti.com on your smartphone, and then put in this 6-digit code, you should see this question pop up, and you can go ahead and respond to it. All right, great. So we've got most of you are education and process, which is probably part of the reason you're here today, learn a little bit more about the standard. Next is not started, so it's a good thing that you guys are getting educated today. And implementation and process and implementation complete is great to see those two. That's higher than I would have expected, so that's great. And we're going to move on to the next one, which is the same question, only with the lease standard. So you should get a little prompt on your phone now saying, go to the next slide. All right, a little bit more in the not started or education and process. This is a little bit further out, so just kind of see where you are at with your peers. A little bit helpful tool there. All right, we can go ahead and get started on revenue recognition. So for public companies, this is actually already effective in calendar year 2018. And for private companies, the calendar year 2019. So if you're a private company, starting January 1st is when this will be effective for you. There are two different implementation methods, full retrospective and modified retrospective. So if you have full retrospective, that means in 2019, when you're issuing your financial statements, all of 2018 and all of 2019 will reflect the new standard as if it was in place the whole time. Modified retrospective, you would show only 2019 information with the new standard, and then whatever would the difference between your contracts in process at the end of 2018, you would show as an adjustment to retained earnings in that first year. So what happened here is basically a lot of the guidance that's out there right now was not very consistent between industries. Or with international standards. So the FASB scrapped all of the guidance currently out there and replaced it with a 5-step model, which seems pretty earth-shattering, but once you walk through the 5 steps with your company, you'll notice there are definitely some changes, but it's not as earth-shattering as you might think, thinking about replacing completely the guidance that's out there right now. So step 1 is identify the contract to the customer. And the biggest change here is collectability. So collectability must be probable, which means 75 to 80%, which might not affect a lot of you. The biggest change for here, what industry would be affected the most, is the medical field, because about a third of their contracts actually the amount of their contracts get collected. And now they're saying if you know up front that you're not going to collect these, then you probably shouldn't call it a contract to begin with. Impact on the industry would be with unapproved change orders. We'll talk about that a little bit more later, but if you have an unapproved change order, and even if it's not just a timing between year end, we're waiting a month to get the signed paper, but if it's significant and you don't know if you'll ever get paid for it, then maybe it shouldn't be part of the contract to begin with. Contracts near the same time with the same customer. So if you have, this probably happens a lot if you work with the same customer repeatedly. If it could be one contract, if it's negotiated, if all of those projects are negotiated as a package deal with one price. If the consideration in one depends on the consideration of another, or if there's goods or services promised that represent a single performance obligation. So engineering and construction together is your single package deal. That would still be a contract. And then termination contracts, if you have a contract where if a contract that hasn't even been started, there's a clause that says that either party could terminate the clause and end the contract, then you might not have a contract either until the contract starts. Step 2 is identify the performance obligation. So this is a new concept. A performance obligation is a promise in the contract that is distinct, and distinct has a definition of 2 criteria. It has to have utility to the customer, which means that the customer can benefit on its own from that good or service without other resources that they have on hand. And it has to be separately identifiable from other contracts or promises in the contract. So it can't be highly dependent on or interrelated with other promises in the contract. So if you have a building with a parking structure that are connected to one another, you have one project manager working on it, and you have one team working on it, it really wouldn't make sense to separate those. That could be considered highly interrelated or interdependent. A series are distinct performance obligations, but that are substantially the same. So if you are creating widgets and you have 20 widgets that you're creating for this customer and they're all the same, even though it's distinct, so it could be a separate performance obligation, the standard says that because it's a series, that can be considered one contract. Impact on the industry, so contracts completed in phases. So if you have engineering, design, fabrication, construction, and installation, you'll have to think about those in the context of some of these questions to determine if you do have separate performance obligations or not. So is it distinct in the context of the contract? So are these highly interrelated or interdependent on one another? Are the risks separable? And do you have various inputs that create a single output? That's probably going to be the biggest question. If you have engineering, design, construction, manufacturing, and you're putting it together all into one product, that really is one thing that you are delivering to the customer, so therefore one performance obligation. And then materiality. So materiality here means the context of the contract, not your financial statements as a whole. And then contract modifications or change order. If a change order comes in and it meets the criteria of being distinct, then you'll need to think about if this should be a separate performance obligation or not, or if it should just be rolled into the current contract. Step 3, determine the transaction price. The biggest change here is variable consideration, which is also a new concept. That's anything that would make your price uncertain. So we'll skip down to the impact on the industry. Unapproved, unpriced change orders, liquidated damages, any kind of bonus or penalty, shared savings, discounts, refunds, rebates, or revenue from claims. They're saying with the new standard that if you will have any of these items, it needs to be considered up front at the start of your contract and applied to the contract price. And that's called applying a constraint. And so this could either be we're either going to get this penalty or not get this penalty, and you either add it or you don't, or if you have, say, a bonus where it's a tiered amount of if we finish in this time, we'll get this amount. If we finish in this time, we'll get this amount. If we finish in this time, we'll get this amount. And you could apply some sort of a weighted average on that. And that should be reconsidered throughout the life of the contract. So if you're a road builder and you think you're going to get a performance bonus for finishing a certain amount of time, but you have issues with a union, which I know that happened this year, and then that changed halfway through the contract. Well, we don't think we're going to get this bonus anymore. Then you'll have to remove it from your transaction price. So it should be looked at on a monthly basis or whenever there's a big change that happens. Step 4, allocate the transaction price to the performance obligation. So good news here, if you don't have multiple performance obligations, you can skip this step. So you will only have a 4-step model. So to do that, you use the standalone selling price. And if the impact on the industry here is if you have a change order that comes in and it is distinct, a separate performance obligation, and that has a price on it, then you would typically use that change order price as probably the best standalone selling price for that. Step 5 is recognize revenue. This is different from the current guidance because under the current guidance, you recognize revenue at a point in time unless you fall into some kind of special criteria, like contractors, to use percentage of completion. Under the new standard, you have to basically go through this criteria to see if you're over time, and if you're not over time, then you're a point in time. So the default is over time first. And there are 3 criteria here. So if the customer concurrently receives or consumes the benefit, which would mean if you came in and did some of your work and stopped halfway through, if a new contractor came in, would they have to significantly reperform your work? If not, then they are concurrently receiving and consuming the benefit. Number 2 is performance that creates or enhances an asset that the customer controls. This will probably be most of you if you're building something. And then number 3 is it does not create an asset with alternative use. So if you're creating cookie cutter widgets and giving them to selling them to clients, then you will likely not fall into this criteria. But if you are creating some kind of a customized product in-house that you're building over time and then selling to the customer, you will if they are liable to pay you for performance to date. So if you're creating a custom project and the contract doesn't say that they have to pay you for costs that you've put in to date, then you wouldn't fall under this criteria. And it only has to be one of these three, and you will recognize revenue over time. And recognizing revenue over time, you would use an input or an output method to measure progress. So very similar to percentage of completion now. Input methods would be machine hours, labor hours, costs incurred to date, and an output method would be performance reached or units produced. And so, like I said, if it's not over time, if you don't meet one of these criteria, then you would be at a point in time. Impact on the industry here, like I said, most contractors will still recognize revenue over time. And then wasted resources, so this would be any labor or materials that don't get you any closer to completing the job. And you should exclude this from progress because you're not getting any closer. And although this might seem like it's a change, it really shouldn't be, because right now if you have a budgeted cost of $500,000 and you have a project manager who's really struggling with getting the job done and helping the team make sure that they're getting the job done, and you have a bunch of extra labor put in, then you really should be adding that to your budgeted amount or estimated amount now, so that you're not showing you're further along in the job than you actually are. So this is really just pointing out that this should be being done now, but also under the new standard, it should also be being done. Uninstalled materials are anything that you might receive, materials that you might receive ahead of time or way ahead of time of actually getting it installed. If they're significant to the contract, then they shouldn't be recognized in your cost to date. They should be recognized to the extent of cost. Since if you get a bunch of materials up front and you plop it into your cost to date, you might show that you're 60% done with the job even though you haven't started it yet. So this is helping that make it a little bit more reasonable. Yes?
Say that one again.
The uninstalled materials. So if you have materials that you receive,
I get a bunch of lights in on December 29th.
yes, are they significant to the contract as a whole, the cost of them?
Absolutely.
Yes. And you probably don't manufacture them yourself, right? Then they're saying that you have to recognize revenue to the extent of cost. So when they come in, say that the bulbs cost $500,000, you'd only recognize revenue of $500,000, and you wouldn't put it in your cost to date.
Would not.
No, until they are installed.
I had that expense already in my books.
Right.
So I need to recognize that revenue.
Yes. Well, if it's in a WIP schedule right now, so you are recognizing revenue, you're probably recognizing too much because you're recognizing the margin on it as well. So,
I get margin.
right, but technically it's not installed until, or you don't get the margin on it until it's installed.
What is that the customer's job says?
That shouldn't make a difference. So the third criteria are if you don't manufacture it, it's installed ahead of time, or you receive it ahead of time before it's installed, and if it's significant to the job.
You could make it so that I get a $500,000 expense with no revenue.
No. You would recognize revenue just the amount to the extent of the cost. So you recognize $500,000 of revenue, $500,000 of cost on day one. And then you plop it into your WIP schedule when you actually install it and recognize the margin on it at that point. Does that make sense? You don't seem too happy about it. So if you have a UHY representative, I've definitely sit down with them and go through, these criteria and see how many jobs they affect. The biggest thing is that in 2018, if you have any jobs that are in process that have that type of situation, you'll want to make sure to figure out what that difference is, because down the road in 2019, if you're doing modified retrospective application, then you'll need to know what that number is to adjust your retained earnings by that amount, and going forward in 2019. Any other questions on uninstalled materials? Okay. All right, so we're done with the 5-step model. Here's a few other considerations. Contract costs to obtain a contract, which is mostly sales commissions. If they are recoverable, if you're billing the client for them, then you can capitalize them and amortize them over the life of the contract. Unless it's if the job is less than a year long, you can choose to not do this. Cost to fulfill a contract, which would be mobilization costs or any kind of type of cost that you need to do internally to set up something, so it's generating or enhancing an internal resource of yours, then you must capitalize this and amortize it over the life of the contract, even if it's less than a year long contract. Principal versus agent. The best way to explain this is to use an example outside of the construction industry on a website that some of you might have been busy on Monday, on Cyber Monday, Amazon. So Amazon has two different ways that they sell products. They sell their own products that they're in their warehouse that they control the price, but they also sell products on their website from a third-party vendor. When they sell products of their own, they have physical possession of it, they carry the inventory risk if something happens to the inventory, they set the prices. So in that context, they'd be a principal, and under the new standard, they wouldn't change how they're recognizing revenue. You'd recognize revenue and then cost of sales for those products. In a agent situation where they have a third-party seller, typically that product is selling and shipping right from the third party. They don't get possession of it, they don't control the price, they don't have the inventory risk, so they are the agent, and in that circumstance you would record revenue and costs net, so like a commission revenue. So how that applies to the construction industry is with subcontractors. So if you get in a contract with a subcontractor and you define the scope of the project and you're able to be involved with the prices and how much you're charging to the customer in the end, then you would just record revenue as you always have as a gross, so revenue and cost of sales. But if you have a subcontractor that's performing all the work on behalf of you and you don't define the scope, you don't define the price, then you might have to determine if this is an agent situation where you're recording costs and revenue net. Does that make sense? Does anybody have questions on that? I know it's a little bit different. It might depend on the circumstance for you specifically with your subcontractors and how your contracts are written. Some other considerations, the only two I'm going to talk about are lost contracts and warranties. Lost contracts will be the same, how they are being recorded now. The only difference is that you're able to elect to recognize loss at a performance obligation level if you have multiple performance obligations versus recording them just on a full contract level. Warranties, if you provide a warranty outside of just a normal standard warranty, if it's a service type warranty over a period of time, then that will typically be a separate performance obligation. Leases. Effective dates for this is 1 year later than revenue recognition. In calendar year 2019 for public companies, and then calendar year 2020 for private companies. And implementation method here is modified retrospective, which is similar to one of the options for revenue recognition. Overview on leases. This includes all property, plant, and equipment. There are a few things that are outside the scope of that, like intangible assets or any assets that are in construction. They changed the lease definition here, and the two biggest things that need to be considered are the right to control the use of an asset over the term. There are some nuances about the word control, so if you're not sure, make sure that you look into that. And then if there's an exchange of consideration, so exchange of money between the two parties. At commencement, you'll have to determine if you have a finance lease or an operating lease. Regardless of which option it would be, you record a liability and a right to use asset. And that right to use asset would be the present value of lease payments with indirect fees, which could be legal fees or commission, and lease payments before or at the commencement date, and then you take out any lease incentives. A finance lease, so this is similar to the guidelines now for capital leases, but the capital lease guidance was a little bit more of they were bright line tests, so 75%, 90%. This is uses a little bit more judgment than the previous guidance. So transfer of ownership at the end of the lease, option to purchase the asset, the lease term is most of the economic useful life, present value payments is greater than or equal to the fair value, or there's no alternative use to the lesser. That is a new line item. So if you meet the definition of any of those with your lease, then you would record it as a finance lease, and if not, it would fall under the operating lease criteria. So here's a little table that shows the difference between finance and operating over the first 3 years of a lease. You'll notice that both finance and operating have a lease liability and a right to use asset. The difference between the two, finance lease records interest expense and amortization expense, and operating lease records lease expense and a reduction in the right-to-use asset. But if you've noticed, the total lease expense for both are both $45,000. So there is no change to the amount of expense, just how it's being recorded and where it shows on your balance sheet and income statement. Affecting the construction industry, if you have any leased construction equipment or vehicles, you'll need to run through these criteria with your with those leases, and all of them will end up on your balance sheet. You'll end up having probably changes to your financial ratios. So that will affect covenants with the bank, and it'll also affect bonding companies, how they look at your financial statements. So make sure that you, once you start to determine the impact on your organization, that you're talking to your bank and your bonding company about those changes. And this could complicate the lease approval process. If right now you have project managers who are able to sign those leases, it might have to go through a couple more channels to make sure how should this be recorded now, and get more of accounting involved on the front end. And related party leases. So there's been a little bit of a debate on this, and at national training this year, manager national training for UHY, we had our trainer talk to the FASB specifically on this topic. So if you have a month-to-month lease that you don't actually have an agreement, it's just kind of what you're doing, you're paying and receiving money each month with your related party, then technically you don't fall under this criteria and you don't have to follow the guidance. However, if that's the case, you don't have a lease, if you have an operating company that has the leasehold improvements on it, they really shouldn't be there. If you don't have a lease, you shouldn't have leasehold improvements. So the FASB is saying you have to write those all off. If you have a month-to-month lease that has a term, so you have an agreement and there's a term, sorry, she just told me 5 more minutes. And if you have a term, then you would apply the guidance, but it would be over the period of time of the lease. If you have a month-to-month agreement that has either party can terminate the lease, then you technically don't have a lease under this criteria and you don't have to apply the guidance. So you might want to talk with your CPA or your UHY representative and talk about how this will affect your specific related parties. Some updates to the standards in 2018. In July, there was an additional transition method that was option that you could add for leases, and then lessors can account for non-lease components with lease components. So right now, common area maintenance expenses or real estate taxes are not included in the standard you don't have to capitalize those as part of your liability and asset. But under this new ASU that came out this year, you can choose to add those into your liability. You'd have a larger liability, but it might just be easier for recognition purposes for you to include those. And then in January, there's a practical expedient for existing land easements. So land easements are a right to use land. And if you have any that are in place in 2020 when this becomes effective, you don't have to do anything with it with a new standard. However, going forward, if you enter into additional land easements after 2020, then you would have to apply the guidance to those. Revenue recognition, there have been no changes since 2016. So that concludes my presentation. Does anybody have any questions right now?
Diane, so a third-party reader of the financial statement, like let's say a bank, a bonding company, insurance agent, what are they going to notice, or is all this done behind the scenes? The client's doing it, Analyte doing all this analysis. What would they look for in the financial statement coming out for 18?
For the lease standard, there would be a huge difference to the balance sheet, depending on how many leases that you have. You'd have a big increase to your liabilities and big increase to your assets. For the revenue recognition standard, it could be a lot of behind the scenes and probably not a huge difference in your revenue, depending on what situations that you have. But you might see revenue either be pulled back into 2018 or 2019 or forward. It kind of depends on which of these criteria would affect you, but there wouldn't be any big change to the balance sheet or the income statement, depending on which of those criteria you would fall under.
Dan, do you happen to know how this is going to affect the tax liabilities and the return to the
I'm not familiar with that, but I know there was a statement that came out that, yes, you're shaking your head, yes.
There's actually a rough draft that came out earlier this year enabling taxpayers to conform their tax methods.
Yes.
to the new GAAP.
Yeah, so then you wouldn't have any big, there wouldn't be any big, I know that was an unanswered question for a while that made a lot of people nervous, so yes. Anyone else? Well, if you have any further questions, make sure to contact your local UHY representative. If you don't have one, contact John Gallo. Some of the questions that you might have might be really specific to your company and your business. And if you haven't, I would make sure that you get with your CPA to go through the list of all the questions. I covered a lot of the big ones, but there are little nitty-gritty ones that I didn't talk about today that might affect you. So make sure that you do that. All right, thank you very much.
Diane. All right, so now we're going to move on to some tax changes. And again, we don't want to make you tax experts, but we want to put some ideas in your head to keep in mind as the tax year comes upon us for year-end planning and when you're talking to your CPA. So just a real brief history. These are the 5 major tax law changes. The first, the 16th Amendment was passed in 1913. There was a change to pay for World War I and II around 1944. Then 1964, and I'm still not even on the timeline yet. 1986, I am around, but I'm doing geometry and playing football as much as I possibly can. So the 86 Act didn't even affect me. But 2017, just this past year, was the Tax Cuts and Jobs Act, which was a major, major overhaul that we haven't seen in over 30 years. So that's why it's such a big deal. And we'll go over a lot of those items in a minute. So who's affected by these tax changes? Businesses, individuals, estates and trusts, nonprofits, all of those entities. Really, everybody's affected by this tax law change. We're not going to really touch on nonprofits, but businesses, individuals, and estate and trust we'll touch on. So we'll go into the changes for individuals. And I love these political cartoons because what makes them funny is they're so true, right? They relate to you in real life, and you're like, yeah, that's so true, and that's what makes it funny to me. So individual tax rates. So these show the 2017 tax rates and the change to the 2018 rates. So there's still the same amount of brackets, but what I'd like to identify is that the top bracket went from 39.6% down to 37%. So that's almost 3 whole percentage points. And then as we move forward, we'll see the other corporations and the other tax brackets and show you how they relate and correlate between one another. One of the major things that everybody in this room can relate to are changes to your individual 1040. So in 2017, the standard deduction was $12,700. And what that means is if you itemized your tax return, if you had less than $12,700, you would get to deduct that off your return. Most people in the country can get above that $12,700 just barely. So you're rifling through to get your mortgage statement, all your charitable contributions, your medical bills, trying to maximize that deduction, where getting over $12,700 really wasn't that hard by the time you add in all of those different items. But in 2018, under the new act, it took that standard deduction from $12,700 all the way up to $24,000. So there's a vast majority of individuals that will never hit that $24,000 of itemized deductions. So you don't even have to worry about that. That's kind of the simplicity that they keep talking about. We're going to make taxes simpler. For the average person, that's probably the number that's in play, so you don't have to pull all that information together, and most people will be taking that standard deduction at 24. In the new tax law, as we go through it, you'll notice that there's a lot of gives and takes. So they give you a benefit, but then they're taking away something as well. And that's how they balance these things out. You can't just take. There has to be an offset. That's usually the thing that they don't advertise. So one of those things is exemptions. So you get an exemption for you, your spouse, any children that you have. And in 2017, that was $4,050 per exemption. In 2018, they got rid of exemptions in total. So you get no deductions for those 10 kids that you had. What good are they now, right? This is just a quick overview of some of the rates. We talked about the top line rate. But in addition to the tax rates, they come into play at different levels of income. So you'll notice that in 2017, you got into the 39.6 bracket at a level of $470,000, whereas to hit that top 37 bracket, you have to get all the way up to $600,000. So that also is an advantage that you're not paying that top rate until you have more income. Qualified dividends are still kept at that very favorable 20% rate. The net investment tax and that high income tax were both part of the Obamacare that I know Trump was trying to really work hard to get rid of. He was unsuccessful. So the 3.8% on interest, dividends, and capital gains, if you have income over $250,000, is still in play. And in addition, you have to pay an additional payroll tax of 0.9% if your income's over $250,000. Those are still in play, but those were pushed really hard to try to get rid of. This is just a quick graph that talks about the Social Security limit. If you see in 2017, it was at $127,000, which was an increase from the prior year of 16 of 7.3%, so it really jumped. In 18, it only went up to $128,000, and it only had an increase of 1.2%. So on the individual side, just a hodgepodge of items. The nasty alternative minimum tax that a lot of people fell into a trap. There was no repeal on the individual side, so individuals still have to pay alternative minimum tax. However, what they did do is, and correct, was the amount of the exemption never increased accordingly, so it was always really set at a low value. So now they've changed the exemption amount. So for an individual, it goes from $54,000 to $70,000, but a married filing joint, which I should have added to the slide, but I hand wrote in, goes up to $109,400. By bringing it up to that level, most individuals now will be able to escape that alternative minimum tax. There was a lot of talk about messing around and changing with 401k levels and how 401ks are administered. There was no change on that plane, so that probably is actually a good thing. One of the other things that they were concerned about was if you're not going to be itemizing, is that going to hold up charitable contributions? So if you are at a level where you still need to itemize because you have more than the $24,000, what they did was, to kind of help out, was previously you could deduct charitable contributions up to 50% of your AGI, and now they bumped that up to 60% of your AGI. So if you're a very wealthy individual, don't necessarily need the cash, and you're typically like older individuals fall into that trap, they donate a lot, you can donate up to 60% of your AGI now and still get a deduction for it. One of the things that a lot of my clients have some heartburn over was if you have a $1 million mortgage previously, if your mortgage was $1 million, after $1 million, the amount of mortgage interest you could deduct was phased out over time. Well, they took that $1 million and they dropped it to $750,000. So if you have a mortgage of $750,000, once you go over that amount, your mortgage interest starts to get phased out. So a lot of people were upset about that. They put into play, though, a grandfather clause, we call it, where if your mortgage was dated before 12/16 of 2017, so it was already in place, then that limitation doesn't apply and it still applies at the $1 million level. Another change that they made was with home equity, lines of credit. Now you can't take out cash and go buy a jet ski or a snowmobile. You have to use that home equity line of credit to buy, build, or substantially improve your home for it to be deductible. And then this one is kind of strange. I don't know why they would have done this. Alimony payments are no longer allowed as a deduction for the person paying the alimony, but it's no longer includable in the payee's income as well. So one of the largest itemized deduction changes is in regards to state and local taxes. So state and local income tax and sales tax are now disallowed as a deduction as a single line item. You actually have to take that and take your state and local property taxes plus your state and local taxes and add those two together, but you're capped at $10,000, and that's a really, really low number. If you think about a person's individual property taxes and then all the state tax that you pay. So that restriction is very detrimental to most people. On the flip side, I guess, on the bright side, the child tax credit increased from $1,000 to $2,000, and the first $1,400 is refundable under the new law, which means you can get that back as straight cash. It doesn't just necessarily reduce down your tax. You can get it refunded back to you. So people in a lesser tax bracket, that really helps out. If you're single with children, it can really help. Regarding estate and gift tax, the estate and gift tax drastically increased. The exemption amount of your estate, if you were to die, was the first $5 million was exempt from estate tax. They took that and basically more than doubled it to $11,180,000, and that's per person. So that's a huge, huge benefit in our estate and gift planning purposes. The tax rate didn't change; it's still 40%, but now you can see that exemption amount is substantially larger. However, it is scheduled to phase out over the next 6 years and sunset unless they reenact it or change it or that kind of thing. So I guess the point here is, with the guy in the casket, we should do our tax planning now. We have 6 years to really get our tax planning in order, right? Take advantage of that exemption amount. Some business changes. Just real quick overview, most people probably know, pass-through entities, which are sole proprietors, partnerships, S corporations. They don't have an actual federal tax. The income flows through to the individual, and they pay at those individual rates that we discussed before, the 37% top line rate. For C corporations, though, they also used to have a bracketed system of tax rates, and they went to a flat tax of 21% across the board, regardless of your level of income. So initially, when people heard that, they said, wow, it's great for big corporations. Trump's doing it for big corporations as well. But you'll see that on this next slide, I thought this was pretty interesting. We have a lot of smaller clients that are also C Corps. And this chart shows that until you reach a level of $90,000 in your corporation, that's where it breaks even between the prior brackets that you were paying and the new 21%. And you have to actually get over that. You have to make about $100,000 before that 21% really benefits you as a corporation. Some other items that most people know. Section 179, it's an IRS code section, but everybody kind of knows what that means. Section 179 is the immediate expensing of equipment. The level in 2017 was $510,000, but now it went up to $1 million. Now there are some phase outs, the $2 million and $2.5 million, but you're able to deduct $1 million, of new equipment, which really will help, reduce down your taxable income. Something that's been around a little while, but not as long as Section 179, is bonus depreciation. Bonus depreciation previously, in 2017, was you could take bonus depreciation and kind of immediate expensing on 50% of any new purchases. So bonus depreciation was installed to facilitate the economy growth. So you're buying new equipment. So you're buying a tractor from Caterpillar or backhoe or something of that nature, where it's brand new equipment, and then therefore they're building the equipment and they're putting people to work. So the whole economy kind of is growing. They've changed bonus depreciation now to say all of your purchases qualify for bonus depreciation, 100%, whether it's new or used. So that's a huge benefit for companies. However, the bonus depreciation is scheduled to phase out. So it's going to stay at that 100% level from 18 to 2022. And then it's going to scale down to 80, 60, 40, 20 until it basically sunsets, or they change it, or do something to the law. Section 199. This actually does not apply going into 2018, but it was such a big change, I wanted to bring it to your attention. Section 199 allowed you to have qualified production income, basically domestic income if you're operating in the U.S., and you were allowed to take a 9% deduction for that. That's pretty large. But again, as we talked about gives and takes, this is one that they took away. The Tax Cut and Jobs Act repealed this deduction. R&D credit, I just wanted to briefly touch on this. Most contractors don't believe they qualify for R&D, and R&D is not white coats and beakers. It's developing new ideas that are new to you as a company, not necessarily, to the rest of the world. So anytime I hear like retrofitting, somebody's doing some retrofitting, changing the method that they're doing to build something, all that, in my mind, perks up to say we should be at least entertaining that there might be some R&D credit. That's free dollars that you get from the government. They expanded what qualifies for R&D, so they want you to use it. They want you to utilize it. I just think a lot of contractors aren't really taking advantage of that, and you should really be thinking about it and at least exploring the possibility that it could be there. The Work Opportunity Tax Credit. Here's another one that I don't think contractors take the maximum advantage of. But the problem here is, if you can see the groups that qualify for this Work Opportunity Tax Credit, unemployed veterans, which everyone likes to help a veteran, but some of these other items like a food stamp recipient, an ex-felon, you don't really know, and people don't really like to disclose those facts that I was an ex-felon. So it's tough to really make sure that you probably have these people on your payroll, but they're not letting you know these things, so you're missing out on the opportunity there. The credit can be up to as much as $8,500 per employee, depending on a lot of criteria and how long they were there and how much they make and type of things like that. But the point is, you should be looking at this because it's hidden dollars that are sitting on your payroll. A lot of times payroll companies do a really good job if you have a payroll service. Once you hire somebody, then they go into the process of filling out paperwork, and a lot of times they're able to identify the individuals that qualify and can run a report to allow you to take this credit. Again, Section 179D, this actually ended at 12/31/17, but you have the opportunity, and we've done this with some of our clients at UHY, and it's been a humongous, tremendous benefit to them to actually go back and amend prior returns for jobs that qualify under this 179D category, especially if you do work for entities that don't pay tax, such as a governmental unit, a university. They're not paying federal tax anyway, so they're allowed to assign you these credits that you can take on your return. That's where we've seen a huge, huge advantage. So if you're doing that type of work, it's something to consider. Now again, your timeline's shrinking, but you could go back and actually amend some returns and see if you can get some dollars. Business net operating losses. Nobody likes to talk about, oh, I lost money this year, right? I mean, that's not what we're in business for. But when you do have a loss, under the previous rules, there was a benefit because you could take that loss, carry it back 2 years, and if you were profitable and made money, you could recoup the tax that you paid in the prior 2 years. And then if you had any excess loss, you could carry that forward. Under the new rules for net operating losses, you're not allowed to carry them back. You're only allowed to carry them forward, but you can only utilize that loss up to 80% of your taxable income. So they're not allowing you to wipe out all the income and pay no tax. You still have 20% of the income that you have to deal with. Now that 20% that you're not allowed to use, you don't lose it. It carries forward indefinitely. But the point is, you're not allowed to wipe out all your income in an individual year from a year that you had a bad loss. One of the things that I wanted to point out was on the business side of things, the alternative minimum tax was repealed, so corporate taxpayers don't have an alternative minimum tax, and the NOL comes into play there because you actually have to calculate your NOL for both regular tax purposes and AMT purposes, and that's gone away. So that's kind of actually a good benefit as well. Section 199A. So this was put into place to really help out the flow-through taxpayer, because the individuals who have, S corporations or partnerships, they said, well, it's really not fair that a C corp gets that 21% rate. My income flows to me, and I'm paying 37. Can you help me out? They instituted Section 199A. It was supposed to be a very simple idea of being able to take 20% of that income, excluding 20% of the income, and paying on 80% of that income that flows to you from your corporation to help lower the income tax rate. In practice, it's a very complicated calculation. So what ends up happening is the income that flows from your company, your S corp, and goes into your personal return, you take that specific income, and there's a bunch of limitations, but as long as you qualify for those limitations, you're able to only get taxed on 80% of that income. So if you're in the top tax bracket of 37%, but you're only getting taxed on 80% of that income, it takes your effective rate from 37% down to 29.6, the 37 times 80%. So effectively, you're only paying 30% on that income. Again, there's a lot of limitations. In addition, people that were in the rental industry, they were fired up because they said, well, wait a minute, your limitation is based on 50% of your wages. In a rental business, we don't have wages, or we have very small wages. So you wouldn't be able to get a deduction at all. So to appease the people in the rental industry, they also put in a limitation for that to say if you're a rental, it's 25% of your wages plus you get 2.5% of your adjusted basis of the property, of basically the building, so that they can also take this deduction. So here's a very basic, I am not good with math. I don't know why I went into accounting. If I don't have a 10 key, I am lost. So I wanted to make the numbers real simple. It's an oversimplified example, but it kind of gives you the idea of what I'm trying to come across. So if you're a C Corp and an S Corp, and you both have $100 of income, that QBI, that's that $199 deduction. You don't get one for the C Corp, but you do for the S Corp. So you get the 20% of the 100. So now you're paying on taxable income of 100 for the C, but only 80 for the S. Now in the C Corp example, it's that flat 21% that we talked about. So you're going to pay $21 of federal tax. On the S Corp, like we discussed, that 37% top bracket comes down to an effective rate of basically 30% or 29.6. So you're paying $29. So you're saying, well, wait a minute, the C Corp is still a better deal. Not necessarily so. In a state like Michigan, a C corporation not only pays federal tax, it pays state tax. So the state tax rate in Michigan is another 6%. So now you get to add $6 more onto your total tax bill, and now you're paying $27 in a C Corp, whereas in the S Corp, there is no state tax in Michigan, so you're at that 29. Now the 27 and 29 are pretty darn close, right? Here's the other kicker that doesn't come into play that people don't think about. In a C corporation, you made the $100, and now it's sitting in your corporation. Now you want to take it out as the owner because, you know, that's the windfall of your labors, right? Is the profit. You take that out as a dividend. It's now taxable a second time, which is the problem with the C corp, and you're taxed at 20%. So that's on top of the $27. So the point of all this is, in certain circumstances, a C corp does come into play and is the better deal, but you really have to analyze the C versus the S and analyze the overall effect and what are you really paying when you look at the numbers. It's not as simple as the C corp has a 21% tax rate. Another deduction that everyone's, I'm sure, familiar with, meals and entertainment. They've changed it so that the meals and food, like food and beverage, they're allowed a 50% deduction. But the entertainment part is non-deductible. So when you're taking your client to the Pistons, the Tigers, those tickets are non-deductible. If you're going to a suite, you have to make sure that that invoice is broken out so you can see the food and beverage portion, the suite portion, the tickets portion. That was a big change. A lot of people have angst about that because they're like, hey, I locked into the new Little Caesars Arena and I have these boxed tickets for the next 5 years, and now I'm not even going to be able to deduct them. So I guess the other reasoning behind that, though, is when the biggest vendor that you have says, I want to go to the Red Wings game, you're going to buy the tickets anyway. It's a cost of business. So no, you don't get the benefit of the 50% deduction, but again, it is a cost of business. This is one of the things that I know is going to get overlooked, so people need to really pay close attention to this. And what it is if you have substantial debt on your books and you have a lot of business interest expense, there's a limitation that you're only allowed to deduct 30% of that based on a adjusted taxable income, which is basically an EBITDA calculation. I know a lot of people know what EBITDA is. That's the big buzz in like banking. What's your EBITDA number? So it's basically taking your income, adjusting it for some additional things, and it kind of gets you back to that EBITDA number. You take 30% of that, and that's what you're limited to for deducting interest expense. Now, this only applies for companies that have average gross receipts of $25 million or more, but that's probably a lot of you out there. Oh, and the interest that's disallowed is still carried forward indefinitely. So you don't lose it. It just gets carried forward to a previous year. You redo the calculation, and maybe you can take some more the next year. One of my staff brought this to my attention. I didn't even know about this. This is a draft of, at the bottom of the screen, it's a draft of the 2018 Form 1065 that the IRS has recently issued. And you'll see on there, line 23 says, interest due under the look-back method. So construction contractors have to do this look-back method where they take their job and they recast it, if hindsight was 2020, because you know exactly what your costs are. Under the look-back method, you have to pay either interest, or you have to pay the government interest if you overstated, or if you understated, the IRS owes you interest back. I've never seen it on an actual 1065 form in that taxes and payments box, so I'm not sure, because typically what happens is you do those calculations at the individual level. Now they're doing it at the entity level. So I guess we'll have to stay tuned to see if that's an actual entity calculation where the partnership would end up having tax due. It's pretty interesting. I never saw that before. So, long-term contracts. So for tax purposes, previously, if you had average gross receipts of $10 million or less, you could be under the completed contract method. That by far is one of the most powerful tax deferral methods that's out there. You're allowed to defer the income on jobs until it's 100% complete. I can't tell you, how powerful that is, as opposed to a percentage of completion and reporting that income over the life of the contract as you earn it. But $10 million in today's day and age for a contractor is really not that high, right? It's a couple good jobs and you're hitting $10 million of gross sales. The Tax Reform Act took that $10 million and bumped it up all the way to $25 million. So now that picks up a whole slew of companies that would qualify to be on the completed contract method. So everybody should be revisiting that, because if you were in that 14 million, 15 million range, right? You didn't qualify for the 10 million. You had to pick it up on PLC. You now qualify because you go from 15 to 25. You have a lot of growth opportunity there where you could be utilizing this completed contract method. Something to keep in mind. So, decisions and decisions. Again, I wanted to reiterate, when you're analyzing this new tax law, it's really not just a numbers game. It's not the 21% rate versus the 37% rate. You need to really look at a lot of things for your individual business. What's the entity's timeline look like? Are you going to hold this business long term? Are you looking to build it up and flip it? What industry are you in? What type of contracts does the company have? Again, construction contracts in the construction industry is totally different than a manufacturing company. Growth plan. What's the plan to grow the company, which includes CapEx, capital expenditures, reinvestment needs? Are you going to be keeping money in the company to build the company up, spending money on capital improvements? Maybe you do want to be a C and not an S, because you're not going to be taking that money out. You're going to be using it to reinvest in the business. And then cash management. What's the purpose and goal of the entity overall? All those things need to be considered, not necessarily just number crunching and tax rates and such. So that's what I wanted to leave you with, was, again, reviewing and analyzing your business and your individual needs is most critical for tax planning. That's my contact info. I know a lot of you already. I know you know how to get a hold of me. If you don't know me, that's how you get a hold of me. That's my direct line at work and my email address. So, is there any questions? Yes, sir.
So, you mentioned that bonus depreciation jumped to 100% this year. Are there any instances where you still want to use Section 179 over bonus depreciation?
That's a great question. So the question was, bonus depreciation is 100%, but the Section 179 is capped at $1 million. Is there an instance where you'd want to use one over the other? For state tax purposes, if you're paying state tax purposes, most states accept 179, but they don't accept bonus depreciation. So if you take bonus depreciation on your federal return, when you go to do your state return, if you're out of state, not necessarily in Michigan, or if you're a C Corp in Michigan, they make you add back that to bonus depreciation you took, and then you have to depreciate it over the standard lives. So basically now you have a whole tax federal depreciation lapse schedule and a state lapse schedule that you have to maintain just for that specific state. So if your capital expenditures are not more than $1 million, it would make more sense to Section 179 and write that off, because you're not going to have to make that adjustment on your state return. So, good question. Thanks. Anything else? All right, I think we're still on track. So we're gonna take a 15-minute break. Let's stretch, do some jumping jacks, get the blood flowing, get some more water, and then we're gonna come back with the second half of the presentation. Thanks.
John Shoemaker. I'm a manager in our Farmington Hills Tax Department. And
I'm Gina Stodecker. I'm a tax partner with Howard & Howard Attorneys out of our Royal Oak office, and have been working with Jonathan on the Opportunity Zone strategy now for a couple months here at least, and have some combined clients. So John asked if we could present this morning, so thank you for having us here. So for just to kind of set the base, who is familiar with Opportunity Zones already? By a show of hands. I know you've been doing a little exercise the last 15 minutes, but so not a lot. Has anybody set up a fund yet? Or been introduced to a fund? Interesting. By way of a little bit of background, I come from a construction background myself. I'm part of a fourth generation closely held mechanical contracting business. So when the Opportunity Zones first came out, I was scratching my head on how is this going to apply in the construction industry. So over the last 9 months since the Opportunity Zone legislation first came out, we've been seeing a lot of really interesting scenarios. And we'll get into the nuances of what it is and how it works. But with regard to how it pertains to the construction industry, we have had some really interesting questions coming from contractors across the country. And so one of the things to keep in mind is this, while it has a tremendous local impact, the national landscape is amazing. There is interest across the country, and regions wondering what's going on with this. So to the extent that you have multi-state operations, I suspect you'll trip on it in one way or another, whether direct from a personal kind of a business owner standpoint or as it relates to your projects. So we have had some interesting questions. I hope you guys do ask some questions today, because we're still figuring things out. The legislation's very new. So to get started, we're going to go through some background on the Opportunity Zone. What are the benefits and why do you care? What are the requirements to obtain, to do such an investment? And then additional considerations, really overlapping some of what John covered already in that first morning session. So this looks a little complex, and it's not meant to be. We're going to go over it one more time. This is just to set the stage of what we're talking about. So the Opportunity Zone is a structure that allows capital gains to be deferred over a 10-year period. But along that 10-year period, there's additional tax benefit that the investor is allowed to take advantage of. And that's what we're going to look at later. So you're going to start hearing some timelines that relate to 5 years, 7 years, this random 2026 time period when a tax must be paid, and then ultimately 10 years, thinking of a transaction that happens now, what happens in 10 years. So this is just to set the landscape of how does this tax-free appreciation work over the period of a 10-year timeline. So this is the Opportunity Zone Fund timeline. So that now you've got your primer, and now let's kind of dive into what is it. So the Opportunity Zone program was part of the Tax Cuts Jobs Act, which John talked about just shortly ago. The intention of it is to spur economic development in communities that have been lacking in terms of job creation and that are economically distressed areas. It motivates and incentivizes individuals to invest in use unrealized gains in distressed communities. So what does that mean? The idea is rather than using tax dollars, meaning tax credit programs or tax incentive programs that are driven by economic development programs, this is intended to tap into unrealized gains of individual investors that can be used to spur economic development in distressed communities. So it's a little different than if you're familiar with other tax abatements and tax credit programs that we've been utilizing for the last several years. All 50 states have designated zones. In Michigan alone, we have probably, what is the number, 250 or so?
It was somewhere north of 200.
Yeah, and we have a map that we can show you where all these zones are. But every state has these zones. So what type of investments are available? Investors must invest through an opportunity fund itself. So there's some confusion around, okay, I've got an asset or I've got property sitting in an opportunity zone, what do I do with it? The first part is that you have to, in order for the structure to work, you have to actually invest through a fund, which is why I asked the question at the onset, who, if any, has looked at establishing one of these through a fund, because many people are looking at establishing their own fund versus going through an independent fund. And both are good options depending on what your business situation might be. So the starting point is you have a fund that can invest in these zones. And then the question is, what type of investments would qualify to allow you to get these wonderful tax breaks over the course of 10 years? So examples available of investments include new construction. So clearly that's why it could be relevant to the folks in this room. Mixed use, commercial, residential, and real estate. And that includes assets that you may currently own. Rehabilitation of existing properties. Certainly we're seeing a lot of that, particularly in the Wayne County market. But I was just telling Jonathan this morning, we're working on projects up in Marquette, Michigan, Milwaukee, Muskegon, Michigan, Peoria. It's really impartial in terms of where the opportunities are and what type of asset it might be that the zone will come into play. What's really fascinating is a lot of people think of Opportunity Zone as being a real estate play, and while it is, and it's a very significant real estate play, it can also be utilized as seed capital for new investments. So if you or your company has a desire to invest in a company, or you were thinking of investing in another company or starting another company, this is a tremendous opportunity to seed that investment with an Opportunity Zone gain. We're seeing it as it relates to, clearly with business expansion, companies are making decisions as to whether they're going to expand in an existing facility or move into a zone to do that capital expansion. Similarly, we're seeing examples with large corporates, which are actually looking at taking equipment and placing that equipment in where they might already have a building or a plant in a zone, moving equipment or acquiring new equipment and putting it into an existing facility. So there's some creative options that you can utilize, but like I said, each scenario is going to be different, and it does take an element of creativity. Business expansion, as I said, is enormous. Relocation into the Opportunity Zone, we're seeing a lot of that. Affordable housing, mixed-use projects, renewable energy projects, that's another one. We have some solar projects going on down in Florida that are transplanting the investment into an Opportunity Zone. And with that, thinking about, we'll talk about this again as well, on the renewable energy projects in particular, there are other ways to utilize other financial stack incentives in some of these programs, and that's what makes the Opportunity Zone so interesting, is that you're not limited to just the benefits of the Opportunity Zone tax play. You can layer in some of these other economic development tools, including renewable energy credits, and clearly infrastructure projects.
Before we move on real quick, we had a couple questions out here.
Sure.
I wasn't aware of the business expansion. Like, how much are you suggesting if I open an office in Detroit in a zone and I broke out the revenue and a EBITDA per se, an evaluation, those same tax rules would apply?
Yeah.
At the 7-10 year mark?
So you might get into some related party issues, but technically yes, that if you have original issue stock in that new business, That would qualify as a new business entering into the zone. Yes.
So when I take a net income from my business from 2018,
You have to have a gain. So now we're getting, so you would,
it's got to be a capital gain.
That's correct.
I can roll that into it. Okay.
yes, yeah. So clearly you've got some, know-how on this. And so now we're getting into what is the starting point of the opportunity zone? It starts with a capital gain of a sale of an asset. So why was it created? Just to back up a tad here. So if you look down here at this red highlighted, that U.S. investors hold an estimated $2.3 trillion in unrealized capital gains. That's what started this program, was how are we going to unleash all of this unrealized capital gain that's sitting either in the stock market or in other equity that investors have. And so that whole idea is, let's stop using tax programs from the IRS, Treasury, and from state governments, and let's utilize taxpayer dollars. So that's really what this is deploying taxpayer dollars into economic development. Interestingly, 5 metro areas in the United States comprised the new businesses combined between 2010 and 2014. So if you think about that the majority of the development that was going on was in 5 major metropolitan areas. And when you see the Opportunity Zone map, you'll see why it matters that they have tried to pull the investments into these rural and non-major metropolitan areas. That said, all of downtown Detroit is an Opportunity Zone for the most part. So the Opportunity Zone investment components require 3 pieces in the structure. So first, as this gentleman mentioned, you have to have a gain, and that gain comes from what would otherwise be the investor. So you start with, you have an investor level as part of the structure, you have the fund, and then you have the eligible investments. So what does that mean? The investors, we're seeing, they can be any type of investor. So this is just by way of example. High net worth individuals, family offices, I'd say is where we're seeing the greatest pickup in this activity. Individuals that have sold their company or are looking to sell their company are looking to divert the proceeds of the sales of those businesses into a fund. Businesses with capital gains. The fund itself can be managed either what I refer to as kind of self-directed. So if you're going to be managing the investment, you've got a particular investment that you want to do, you can structure it such that your gain and fund are self-directed, or you can go through a third-party fund. So we're seeing a lot happening there in kind of the fund manager area. We actually are seeing new funds established across the country. Some of them are in staggering amounts. We're working with a client on a fund. It was literally 10 individuals, $10 million gains apiece, and it's down in Miami on a development piece in downtown Miami. We're working on other ones that are much smaller than that, and we're actually setting up a fund in Peoria that's an economically driven fund that has participants that include gains that were structured through an endowment fund. So it's really a contrast in terms of what these funds look like. The eligible investments can be in the form of stock. So as I mentioned earlier, kind of the original issue into a new business or an existing business issues stock. That could be an investment that the fund would make. Partnership interest, real estate, clearly. We're seeing a lot of activity on the real estate, and business property. It could be existing or new. So the zones themselves were established at the state level. So each state had the ability to select 25% of their low-income distressed communities were eligible to be put into these zones. So looking at what qualifies with a poverty rate of at least 20%, median family income lower than 80%. So clearly these are areas that require or are looking for new commercial development. States could nominate up to 25% of their low-income census tracts as zones, which is what we saw in Michigan. And Michigan has 288 qualified census tracts out of a potential 1,150 so eligible tracts. So we'll see interesting scenarios where for instance, we're working on one just outside Ann Arbor, and the entire campus of an existing business is situated across the street from a zone. They sold property, and they're asking the question, can this contiguous property, but it is across the street, can we qualify that? Not necessarily, but what we can do is use the gain that they generated and set up a structure literally across the street to then protect that gain and then put a different operating entity, whether it's a marketing portion of the group, whether it's one of the other siblings in the company. So that's what I mean about being creative about how you can utilize these zones even if you aren't necessarily situated in one yourself. So here's the map. I wish we had an interactive map, and you can, down at the bottom, and I know we're going to send these slides around, you can go like literally right into the address that you might be looking for. I was with a client yesterday, and he didn't realize that he had property up in Marquette that was sitting right in the middle of a zone. But as you can see, we've got this area kind of right in the central United States area. We've got large pockets of massive zones. One really interesting area is out in California in San Jose. A good part of San Jose is designated zone, which I find so fascinating considering its location with Silicon Valley. But in Detroit, really Wayne County, I know there's some zones in Troy. I mean, you got to really get into the map and kind of look at where you might be looking at new investments or where you might have construction projects going on. I think it's worth looking at the map. We're getting some really interesting stories around how companies are looking at using the zones as a marketing tool. If they're going to go into a project in St. Louis, for example, trying to do that through a zone infrastructure investment as opposed to just going in there and doing their job the way that they normally would. So here's the map. I definitely suggest people to get on there, take a look at the various areas. Here is Wayne County, and as you can see, clearly downtown Detroit got its share of designations. I don't know this for certain, but I have heard that the Governor's Council, when they solicited what zones were going to qualify, that there was a heavy hand in the Detroit audience in terms of how those designations were selected. But like I said, north of Wayne County, there's certainly a lot of opportunity as well. So who's eligible? This is where it starts. The Opportunity Zone tax benefits investors with unrealized capital gains, starting in 2018. So it must be a capital gain generated through a sale to an unrelated party, and it can be from the sale of stock, real estate, or a business asset. And here's this timeline that I alluded to earlier. Once the gain is finalized, or once the gain is triggered, that investment must be put into a fund, an Opportunity Zone fund, within 180 days. So that's something to keep in mind, that if you had a gain that you realized in 2018 and that you're contemplating, could this be utilized for Opportunity Zone strategy, there's ways that you can stretch out that 180 days, thinking about when it was truly recognized. But certainly if you had a gain in 2018, you should be talking to your advisors at UHY to make sure that you have incorporated that Opportunity Zone strategy in your planning. And the other point here is that you're not required to invest the entire proceeds. So unlike a 1031 exchange, with the Opportunity Zone, you have this flexibility to say, all right, I sold my business, I need this amount of liquidity, I want to take this portion and put it into stock, whatever, and I'm going to take this portion and invest through a fund. We're seeing a lot of structures like that. So that's what's wonderful about the Opportunity Zone structure, is that you have the flexibility to invest whatever portion of it you want to invest. So what's driving all the enthusiasm around this is really these three elements of tax savings to the investor, to the person to the individual or the entity that has the capital gain. There is a temporary tax deferral strategy, again, thinking about that timeline. There's a partial forgiveness of the tax that's due on the original gain. And then there is this tax-free appreciation, assuming you hold the asset or the investment over a period of 10 years. So the temporary deferral. What this does is say a gain that you recognize, let's just say in 2018, you are going to defer any tax due on that to the extent that you invested in an Opportunity Zone fund until 2026. And technically, you're not going to pay that really until you pay your tax bill in 2027. That's correct, right, Jonathan?
Correct.
Which is wonderful. So you've got this immediate tax deferral in 2018. The additional part of that is that you get this partial forgiveness. So in the worst case scenario, if you take that gain and defer it until that payment that's due as of 12/31/2026, you get this immediate step up in basis up to 15% if you hold it until 2026 for this minimum 7-year period. And by doing so, you're going to get a 15% reduction on what your tax would otherwise be on that gain. So worst case scenario, assuming that you've got an appreciating asset in that investment fund, you've got a 15% reduction on that original tax that you would have paid based on the gain in 2018. And then the last piece is this permanent tax benefit. The proceeds you put into the fund, assuming that they stay in the fund for the 10 years, and they can be reinvested within the fund. You don't have to stay into that single asset that you may have originally intended to invest in. You get a permanent exclusion on any appreciation of that new investment in the fund, as long as you keep that in there for a period of 10 years. So that's what's so incredible, is you get the immediate tax deferral until 2026. You get a reduction of your capital gain tax that is due in 2026, and then assuming the asset or assets appreciate over that 10-year period, 100% tax-free on the appreciation of that asset. That's what's catching the eye of so many investors.
And I think the one thing to highlight there is if you get to 2026, and let's say the value of your asset has decreased substantially, you're not going to pay that entire capital gain. You're going to get a discount to what the new fair market value of that investment is. So that way when you sell a couple years later, you don't in the future have this significant capital loss to offset that capital gain that you recognized in 2026.
Yeah, I think that's a really clever part of the statute, that they're recognizing you're taking a risk investing in these distressed communities. So there's a potential, right? It's not going to appreciate. So assuming there could be a depreciation of the investment, it's giving you an accommodation that you get the lesser of the current fair market value or the 15% capital gain reduction. Yes?
I'm struggling a little bit with following the ownership chain of the new asset, the new investment. So the capital gain goes into a fund.
Yes.
But then I'm the investor. Do I benefit from the development of the real estate that's funded through the fund?
Yes. And so,
Can I have fee in that real estate as well, and then have all the benefits?
Absolutely. And that's where earlier when John was talking about kind of the 179 and bonus depreciation, all of those attributes still matter. So assuming you invested in a fund that's in real estate development, you still will have assuming it's an appreciation and viable investment, you're going to have operating income, and you're going to have other ordinary income coming off, or other income spinning off that investment. That can be passed on. Now that's going to get passed on at ordinary income rates. That's not going to be tax protected other than through these other usual strategies. It's the exit that is tax protected. But yes, you are an investor in that fund, and you will reap the benefits of that development.
Directly as a fee owner of real estate, or?
Yes.
Okay.
Yes. Mm-hmm. So in this example here, we're looking at a comparison of if you were just to invest in an appreciating property of that gain that you realized in 2018. So assuming that you sell stock and realize a gain of $1 million, taxpayer can reinvest that million of capital gain proceeds in a fully taxed portfolio or an Oz fund. And just for fun, we've made some assumptions here of a pretty well-performing 8% annual investment appreciation and about a 23.5% long-term capital gain rate. So this gets into the nuances of showing where you've got year one, the immediate zero tax liability associated with that gain. Why year 5 matters is that there is this component that if you keep that investment in the fund for a minimum of 5 years, you're going to get this immediate stepped up in basis. This is this partial forgiveness that we talked about. And so here you're getting an additional benefit associated with less tax due on that investment if you were to sell at that point. Similarly, in year 7, you're getting an additional 5% pickup. So years 5 and 7 is what gives you this new 15% basis pickup. And then finally, in year 10, if there's a sales price after years 10, and these are assuming many different assumptions, that you would basically have an appreciated asset after tax funds available of nearly $2 million in comparison to this 1.3. What we're trying to show here is that use of tax, unpaid taxes, unnecessary taxes due, is allowing you to invest and then also have the tax appreciation, or the appreciation tax-free rather.
And another big thing there, though, is, that's assuming that 8% return. That difference could be significantly different if, you hit a home run on your investment. And so you really can't quantify what the potential benefits are. It's just going to depend, investment to investment. So now we're going to talk a little bit more about the specifics of the requirements of, an opportunity fund. The first requirement is that it has to be structured as either a corporation or a partnership. And then it has to be certified by the U.S. Department of Treasury. Now, this doesn't mean you have to file an application and wait for them to approve it. It's a self-certification process. There's a Form 8996, which has been released. It's not finalized yet, but the draft of the form is out there. And then once you have the fund established, you have to invest at least 90% of the cash into assets that are considered qualified opportunity zone property. This includes qualified opportunity zone stock, partnership interests, and business property. One of the common questions that we get is, hey, I want to put $1 million into this fund. I only have, how much time do I have until I invest it in this qualified opportunity zone property? They have two measurement periods. The first is the last day of the first 6-month period, and then the second is the last day of the year. Well, let's say you created the fund in September. Now you have an issue where your only measurement date is the last day of the year. And now what if you don't have 90% of that invested in the qualified property? They released some guidance that gives you a safe harbor to have up to 31 months to get that cash fully invested. Now, you can't just put the money into a fund and then sit on it. You have to have a written plan in place of how you expect the cash to be spent. And then at the end of it, you have to have substantially met your written plan of action. Here's a typical structure. So you're the investor, you put the money into the Opportunity Zone Fund, and then the fund would then invest in Opportunity Zone property, which could be either a business, could be business property, and whatnot. One of the other things to highlight here is the Opportunity Zone Fund can't invest into another fund. Another common question we get is, hey, I want to put the money into this Opportunity Zone Fund, and then from there, it's going to invest into other funds. Unfortunately, you can't do that. One of the other big pieces to note here is, as Gina's talked about, that 180 days. So you realize the gain, and then you have 180 days to put the money into the fund. Where it really comes into play is, when do you realize the gain? So let's say you are an investor in a partnership, and then that partnership sells the assets, which are going to flow to you on your K-1. Well, you haven't actually realized that gain until the partnership's tax year ended. So even though the gain might have happened in June within the partnership, it didn't go to you, the investor, until December 31st. So your 180 days doesn't start till the December 31st date. Now, if the partnership is going to then take those funds and invest into an opportunity fund, then the 180 days starts the date that the cash was actually received. So there's a little bit of planning that you can do to take advantage of that rule. The other thing, let's say it's going to flow to you on your K-1, so your day doesn't start till December 31st, but you want to invest the money on December 1st. So your 180-day window hasn't started yet, but you want to already invest. There's an election in place that you can make to have the partnership's gain realization date apply to you as the investor. So what is qualified opportunity zone property? It could be stock or a partnership interest. That stock or partnership interest needs to be a qualified opportunity zone business, which means that substantially all of the assets are located in opportunity zone. They've defined substantially all to be at least 70%. And then also your businesses can't be anything that's considered a sin business, so a gambling parlor, a hot tub facility, golf course, country club, stuff of that nature. And then also your stock or partnership interest needs to be acquired solely in exchange for cash after December 31st, 2017.
I would only add here two interesting elements. The sin businesses, surprisingly, no stadiums. I mean, stadiums are not excluded from that. So I can see many wonderful scenarios using that in an opportunity zone, which frankly, that's where a lot of the zones would be anyway, or stadiums might end up. And the other is you could literally have a transaction that's still closed in let's just say the fourth quarter of 2017, but if you were on an installment sale or some type of a longer term earnout, that your gain wasn't recognized till sometime in 2018. So for anyone that had a transaction that carried over multiple years, I think looking at the date upon which that gain was truly realized is worth taking a look at to see if you can still take advantage of it in 2018.
If you put the money into the business and it says it has to be solely for cash, so you can't finance the business as well as the money that you put up? Am I reading that right?
I think that's related to the gain. Yeah.
That's in relation to your acquisition as the
Correct.
investor in the business. Once you have that in place, the business can finance additional acquisitions and whatnot.
In fact, it can be used that proceed that goes into the fund can be leveraged as collateral for additional financing as part of the financial stack.
If you're deferring, in that example, $1 million, you're deferring the 200 and some thousand.
Yes.
Where is that going? You reduce the capital to invest. So if I give $1 million to a fund, where's that $250,000 going? If I defer it for 7 or 10 years, why can't I use that cash as my capital 100%?
You are. So you're in the fund. It's going into the fund at $1 million. I mean, that's your investment. That's the difference. Is that it's the.
You're just showing it. It's essentially.
Exactly.
Okay.
That's exactly right. Yeah. No, but you're using the entire $1 million as proceeds into the fund if you choose to do that. Yeah.
One of the other things I'd like to highlight, though, in relation to that gain that you're deferring until 2026, is if your money is tied up in that investment and you're not going to sell that investment until 10 years, 12 years, 15 years down the road, you're going to have other sources of cash to pay that tax when it comes due in 2026, that 85% tax. So that's another thing that I always make sure to highlight when I'm talking to clients, to make sure that they do have those other sources. Now it's hard to look in the 8 ball and see what they have in 2026, but generally they're going to need other sources to fund that tax bill. So what's qualified opportunity zone business property? That's tangible property used in a qualified opportunity zone business. Again, the property has to be acquired after December 31st, 2017. The property must be purchased by the fund from an unrelated party, which means less than 20% common ownership. So a little bit more strict than the typical related party rules we're used to, which is 50% for most partnership rules. And then the original use of the property has to commence within the zone. So if you're acquiring used property, that property needs to have been located outside of the zone and you're bringing it into the zone. Now, one of the most common areas we see is obviously with real estate. So you want to acquire a building that's already there. There's a requirement that you have to substantially improve the property. And what substantial improvement means is that you've doubled the basis, or more than doubled the basis, I should say, of the property within a 30-month period. So the easiest example is you acquired a building for $1 million. You allocate $250,000 to land. So now you have $750,000 of basis in the building. So over the next 30 months, you need to spend at least $750,000 plus 1 penny to exceed doubling the basis. One of the questions we got early on was in relation to, well, what about the land? How do we substantially improve the land? When they came out with proposed regulations, they said, no, the land's going to be excluded. One of the things I find most interesting here is in the past, every time we acquired a building, the strategy is, okay, how little can we allocate to the land? Because we wanted to maximize the value allocated to the building to increase our depreciation deductions. Well, now we have the complete opposite incentive where we want to allocate more to the land, less to the building, so it's easier for us to meet that substantial improvement.
So if I already own empty property sitting in a zone, I make $1 of improvement to it, I've satisfied my substantial improvement.
Exactly. Right? And then, I talked about the self-certification process. That's typically going to be for the investor that has an idea of, hey, I want to acquire this property, or I want to open this business. I'm going to set up this fund and do this all myself. Well, there's a lot of venture capital firms out there that are raising money for these funds. So if you're somebody that really has no idea what you want to invest in, but you know that you have this huge capital gain that you'd like to defer, you can go to other sources and essentially just throw your money at an investment and let them operate it. Now, obviously, you want to do your homework and make sure that that you think it's going to be a good investment. Rely on your business advisors to help you make that decision. But certainly, there's a ton out there. This is just a very small example, but yeah. And then also, a lot of these. These funds are going to be in these opportunity zones, and there's a lot of credits out there for new businesses. Combining it with R&D, low-income housing tax credits. There's a lot of people that are investing in residential property in the opportunity zones, and then obviously. Cost segregation studies are still going to be very important. You're doing all these renovations. You're going to want the accelerated depreciation to reduce your tax along the life of the investment. So here's a list.
Well, I think what's important is some of this is getting lost into the opportunity zone discussion because there's so much about the gain to the investor, but you still have to maintain these other tax benefits associated. One, for state tax purposes. A lot of the states have some are coming out with some legislation around opportunity zones. I'm not aware of anything in Michigan specifically. I know Ohio, Missouri, I think Minnesota, some other states are looking at conforming and having a complementary opportunity zone strategy on the state side. But this is why, one of the biggest reasons why I think some of these traditional other incentive areas are going to be even more important at the state level, because you're going to have this disparity between your Fed tax and your state tax liabilities. One of the items, I know John already spoke to the R&D tax credit in particular. I just want to highlight that because a lot of these are going to require new investment, design, engineering, new build, construction. The R&D tax credit, in my mind, is going to be even more significant considering all of this new construction. So keep that in mind to the extent that you have architectural, engineering, BIM, or other virtual design components, process methodologies in your operations. Those should all be qualifying activities that you should be thinking about for the research tax credit. While we don't have it in Michigan, we certainly have that at the federal level, and most of our neighboring states have the research tax credit as well. Additional considerations. We've talked about the timeline quite a bit. It is something, though, to keep in mind. To maximize the benefit with the opportunity zone, everyone's saying you got to get your investments done by the end of 2019. There is some truth to that, because the idea is that there's running clock to 2026. But really, if you think about these investments, even if you make the investment on the last day of December 2026, you have this endless 10-year appreciation that's still going to be tax-free.
Yeah, ultimately the piece that you're losing out on the longer you wait is that 15% permanent exclusion.
And the deferral. And the original deferral.
Yeah, and the deferral is going to be a much shorter period, obviously. But ultimately it's that long-term benefit that's really the meat of what this whole incentive is about.
So when you read, because all you got to do is type in OZ and in Google, and there's an overwhelming amount of information. So this idea that to maximize, there is truth to that you need to make these investments by the end of 2019, but don't let that get in the way of knowing that there are these investments down the road will still matter and will still apply within this strategy. The 180 days to invest is important, thinking about if you're going to trigger a gain or if you have flexibility in triggering gains. Keep in mind that 180 days that you have to invest in the fund, and then you have additional time for the fund to make the investments in the assets that they're intending to sponsor. But that 180-day window is important to keep in mind with regard to that initial gain that's triggered. The other thing is mixed fund investments. So the fund itself can invest in Wayne County and San Jose. The fund itself needs to be able to demonstrate that 90% of its assets are in a zone. Now, we've had really interesting scenarios. What if you have a mobile asset? What if you have a business in a zone that has mobile assets, trucks, vehicles, things of that nature? So those are things that you need to consider as well. We believe that there is an argument that even though those are mobile assets, that the business itself is still contained in the zone. So don't let some of these other characteristics necessarily rule out that those could be qualified businesses in a zone. But the point here is that you could invest in, let's say you've got some idea that you think is going to be the unicorn, or you think you've got an individual that you want to invest in. You can have a business asset investing in an entity itself, and you can be investing in real estate. So this idea that the fund can be very flexible and diverse works very, very, very well. Obviously, understanding the community dynamics. If you don't know the community, probably not a good idea to be investing in that fund. So you do need to understand what's going on in that community. And again, just that self-directed versus professionally managed funds. There's a lot out there. There's a lot of choices, and just can't recommend enough to have a second set of eyes look at some of those structures. We're seeing management fees everywhere from 1.5% to 4% on some of the funds. And like I said, a lot of the family offices are just choosing to go kind of on a self-directed, set up their own fund and avoid that altogether. We talked about the state tax implications. I think just, again, keep in mind the idea that you're going to have this nonconformance between what your federal tax liability might look like and what your state tax liability is going to look like. And do keep in mind, as I said, I haven't heard any legislation at Michigan as it relates to any Oz fund legislation, but I suspect we're going to see some of that coming down the road here. Ohio jumped on it right away. Also, everything we're talking about here is proposed. So while it's final, the statute itself is final, we're doing a lot of reading into the regulations. The proposed regulations didn't come out until October.
Beginning of October.
Yeah, and so for the first 6 months of this, we were all using our know-how in other areas to kind of liken what we thought the regulations might look like. The proposed regulations were very helpful. We expect to see another round of them coming out in January. So I think now is a good time to get into this. I don't think not having final regulations should steer you into not going into this strategy.
Yeah, there's definitely a lot of investments out there that are slam dunks that are much easier to make. Now, there's obviously going to be a lot of gray situations. We see unique stuff all the time where maybe it does make sense to wait and see what the next set of regulations look like. Especially if you're in a situation where, like I said, you can defer that gain until December 31st to start your 180-day window. It buys us a little extra time. You can think about that when you're structuring deals, whether or not you're selling the stock of a business you own or if you're selling the assets, impacting ultimately how you recognize the gain as the shareholder.
Lender considerations. I know there are a few banks in the. I would say just in terms of it could slow down the financial stack, but it also can really help get the deal done in terms of this additional capital coming into the structure. And of course the leverage, the ability that you could leverage against those investments in the fund itself, or the gain, the proceeds in the fund itself. Securities laws, I just mentioned this to any people that are considering setting up their own funds and bringing in outside investors. We are seeing some trips there along the way that, depending on how you are soliciting your potential investors, you do need to keep this in mind. And that's an entirely different discussion, but just be mindful of that if you are looking at setting up your own fund and bringing in outside investors. It is a very competitive climate for Oz fund investments. It's hard to walk into a room and not find someone that's been approached to either set up their own fund or enter into a fund with another partner. So it's a very competitive environment right now. And there's a lot of partnering going on. The local communities do not know very much about this, so if there's anyone in here from the city, I apologize, but I feel like we are doing a lot of educating as it relates to the economic development arms. And so there's an advantage if you know what you're doing, and a lot of it does require kind of teaching them along the way. And that's all we have. So are there any questions?
What are the tax implications of reinvesting proceeds back into the fund, through the life of the investment?
I think that's one of the great tools. It's this recycling. As long as you recycle, that's the way I put it, the investment back into the fund, it's protected for the life of the 10 years.
And if you dispose of your interest in a fund, you can take those proceeds and recycle it into a new fund. It doesn't even have to be necessarily within that same fund.
Yeah. And to that end, we are seeing funds set up that include both capital gains that are eligible and non. So you can have funds, which just means the fund has this compliance and management requirement, but I suspect we're going to see a fair amount of that as well to kind of complete the fundraise, that they're going to be bringing in non-gain funds as well. And then it's just a matter of, that's on the fund to make sure that they can, that's where you guys come in, I think, from an accounting standpoint, really managing the compliance of those funds. Anything else? Okay. Well, with that, thank you for your attention. I hope that was helpful. Thank you very much.
No, I think you're over, to be honest. Right? Are they over a little bit? I think they were. Oh no, they're on time. Oh, perfect. Good job. Yeah, no, that's fine. So does everybody have mics? They're getting mics right now. Okay, all right. Well, thanks, Gina and John. That's a lot of great information to digest, I'm sure. So again, I want to stress to you guys that if you walk away, you're driving home in your car, and man, that was great, but what about this question? Please feel free to reach out to John, to Gina, to myself, and we will definitely get back to you with the answers that you need. So next up, I'd like to introduce Mary Lefevre from Crispin, and she has some associates that she's going to introduce, and they're going to give you all their background, and they're going to talk about the national and local factors driving our construction market. Thanks.
Thank you. Good morning, everybody. How are you doing?
Okay.
Excellent. So I am Mary Lefevre. I'm the Regional Business Development Director for the Crispin Company. And I have here with me today Anthony Bango. He's our Vice President of our PPG, that's our Project Planning Group. And under that umbrella is our pre-construction services, our estimating, our virtual design and construction with our BIM, as well as our sustainability group. And also Jim Like, who is Vice President of CCI, which is Crispin Constructors, Inc., which is a separate company within our organization that is our self-perform. So we're going to talk a little bit today about several different things. I'll start out by giving you an overview of the Crispin Company. Anthony's going to do somewhat of a deep dive into the macroeconomic factors that affect our industry. Then he's going to hone in and talk a little bit more detail about Detroit and southeastern Michigan specifically. And Jim is going to talk about labor and what's going on there and some of the trends and what's going on with the pension. And then I'm going to wrap up with some upcoming construction project that Chrisman has on deck. So who here has heard of Chrisman and is familiar with us? Raise your hand. Good number of people. That's good. I like that. So just some stats of Chrisman. Next year we're going to be celebrating our 125th year of business, so we're really excited about that. We have 3 offices here in Michigan and then 5 outstate. So I wanted to share our corporate values with you because I think this really embodies our culture. Our purpose is to unite great people in great achievement, and that's really the underlying goal of all of our employees. Our culture is really what drew me to the company. I'd also like to back up a little bit, and as we were preparing, it occurred to me that the 3 of us all joined Chrisman at about the same time, so 5 or 6 years ago. And but we have a lot of other years in the industry, and we've been here working and living in the Detroit area all of our career. So we've seen the highs and lows of the economy, how the construction industry tracks with that. So, I mean, it seems like it was just yesterday that, well, a few years ago now, that I would walk outside of the Buell building and, you could pretty much shoot a cannon down the road. And, that's certainly not the case today. A lot more activity. So what do? We are construction managers. About 80% of our work, maybe 90% of our work is done under a negotiated basis where we guarantee cost and schedule for our clients. We do have a real estate development arm that was formed about 15 years ago when it was born out of the needs of our clients. So we do selective development in Michigan and across the country. As I mentioned, we also have a self-perform arm, CCI, and we self-perform structural concrete, carpentry, and some select demolition.
Excavation.
And
excavation.
Excavation. Thank you, Jim. So we're really excited to be a part of Detroit. We have really rich and deep history going back over 100 years. I was most excited when I joined the company to learn that we built the Fisher Building. That's really the world's largest art object. That's when the Fisher brothers commissioned Albert Kahn to design it. And it really is a beautiful building. We moved back into that space about 3.5 years ago. So we are on the 26th floor. I invite you all to come down and see us if you're ever in the area. We love to show off our space. The 26th, 27th, and 28th floors were the original suite of offices for the Fisher brothers. So it's got some really beautiful historic plaster ceilings. And we're looking at moving up into the 27th floor as well. So we are expanding. So we've been honored to be part of Crane's Fast 50. We're on the largest contractor list in Detroit. And most recently, we've been awarded from the Detroit Free Press as a top place to work. Again, it's one of our values to be a great place to work. Okay, so when John asked us to speak, he said, just to talk about some of your construction projects. So I'd like to start with some of the ones that we've recently completed. So this is the University of Michigan, Brighton Health Center South. So that's over in Brighton. If you know where the ski hill is, it's kind of at the foot of that. And this really is a hospital that has over 67 health services, I believe, for adult and pediatrics. And it has just about everything except for inpatient beds. You just can't stay the night there. But you can go there for cardiac, it's got emergency, it's got surgery, sports medicine, you name it, they seem to have it. We recently completed the Mike Ilitch School of Business, so that's downtown, right in the business district there. We did that with a joint venture partner, Alice Brinker. And you may have noticed over the last couple of months that when you drive by the former Wayne County building that it's all lit up. So we worked with the developer out of New York and had a contract to really stabilize the building, make sure it's watertight, cleaned up the inside, and then did the beautiful lighting. We just turned over the Student Center at Oakland University, so this is right in the middle of campus. This was a $35 million project that was occupied while we were doing the addition and renovations, and that too turned out really quite beautiful. University of Michigan Art and Architecture, we did the Taubman Wing. That one is actually a couple of years old, but I wanted to show this one. I think the architecture is quite beautiful. Some of our current projects, so we are down at the Theater 11 Courthouse, and we are doing a project that's about $110 million. And this is challenging because this is 100% occupied. So it's a long phased project. We're completely redoing the MEP system. If you're familiar with the project, it really sits on a city block, and it has a completely enclosed courtyard, and we are adding a stairway inside that courtyard. We are at the Detroit Masonic Temple. This was one of the buildings that we built many, many years ago, and we are working with them to restore some of the rooms and doing some additions and renovations, looking at their mechanical systems. And right now, under construction, we are working with the Pistons and Henry Ford Health System. So we actually have 2 contracts for that project. The first one is for the Detroit Pistons. So basically, the Palace of Auburn Hills and their offices up in Auburn Hills are going to be moving down their corporate headquarters to that building. So we have a contract with them for that. And then Henry Ford Health System, we're doing a parking deck in the Center for Athletic Medicine. And this is located right in the Fisher Building area. So in the New Center area, you can see the picture on the right is pretty much where it is today. So it's a view out of our office building. And that is scheduled to be turned over next summer. We're also building the Little Caesars Global Resource Center. This is in the theater district, right next to the Fox Theater. You can see the connecting bridge to the Fox. And that will also be done beginning of next year. 985 Michigan Ave, that's a project we're doing for the General Services Administration. So that's about a $75 million project. It's a former IRS building, and that's a consolidation of different federal services that are around the city will go into that building. We're working with Olympia Development of Michigan and doing 3 buildings. So the Women's City Club, 1217 Woodward, and 1922 Cass Building, those are all located just west of Woodward, right behind the theater district. So we're doing the core and shell for all 3 of those. One of the markets that we work heavily in is historic preservation. And this is a project that we're doing right now at the Henry Ford Estates in Fairlane in Dearborn. And we've taken a couple of their rooms and through Jim's group are restoring them to really their original grandeur and using photographs to replicate what was then back to today. So with that intro of Chrisman, I'm going to turn it over to Anthony.
Okay, very good. Sounds like you can hear me, right? Yes. Okay, very good. So we're approached all the time by clients that want us to put together a capital budget for a project, or maybe they want to validate their budget on a major project. And when that happens, a lot of times the project isn't actually going to start construction for maybe 1 or 2 years. There's all that planning, engineering, site investigation work that has to occur. So we need to be able to project the cost of construction out over 1, maybe 2 years. I don't like to go beyond 2 years, especially in the Trump economy. I can tell you that. You know, if the stock market is any indication of the volatility we're facing, I mean, I believe it is. So what we did was we took a look at economic factors, and we focused in on Detroit. Detroit is, you know, is unusual in that you have a lot of different forces going on here, a lot of economic activity. One of the things, the term I like to use, and I don't know if it's a if it's accepted in the industry, but this idea of urbanization, right? And so we have momentum in Detroit, and that's what we're seeing. And it's going to continue as the center core of the city is developed, right? And it'll continue to grow. And certainly the Corktown development with Ford Motor Company is going to help that part of the city grow. So all that has to be kind of factored in. So we conducted a 3-month study and basically on Detroit, and that's what I'm going to be presenting right now. So the cost of construction, what do you take a look at when you're trying to project the cost of construction? It's very complicated. And I'll be honest with you, a lot of it and some of it is crystal ball kind of stuff. I mean, let's be honest, right? Because things change all the time. But these are the things we look at. We look at macroeconomic factors. Certainly the cost of petroleum impacts construction, not only in terms of delivery and operating equipment, but also certain things like PVC pipe or asphalt. The valuation of the dollar. You know, if you look at the Little Caesars Research Center, you may have noticed some pretty interesting glass on that building. You know, that glass was not basically manufactured here in the United States. So the value of the dollar and our ability to buy from overseas products is important and impacts the cost of construction. Emerging economies and the world economy, that has a big impact too, because it impacts the demand curve in terms of in the world, in terms of steel and things like that. U.S. construction start projections, obviously, again, that impacts the demand curve, and we're going to look at those in a minute. Cost of materials, that's a given. Regional demand for labor, this is one of the big ones that impacts the cost, overall cost of construction. If you look at a typical capital project, probably half of it is labor. Half of the direct cost is labor for a building, right? So it obviously has a big impact. And then I put down the tax reform bill, the repatriation of really billions of dollars. Now, how much of that has been spent on capital projects? We're going to need maybe somebody else to help determine that, but we believe it's having an impact. All right, this is, now I'm going to start with the United States, and then we're going to kind of work our way down to Detroit, okay? So this is FMI, Fales Management Institute, their projection. And you can see this is, you know, they have residential, non-residential, and non-building structures. The black line is non-residential, and that's really my comments are going to focus on non-residential today. So you're seeing, you know, into 2019, plus 6% in terms of construction activity they're projecting in the United States. And they're showing the arrow continuing up through 20 and 21. I love this map because this kind of shows you the whole United States in terms of construction activity. This is Fales again. The size of the ball, if you will, is the amount of dollars spent in that region. And then the color of that bubble tells you the amount of growth that they're projecting. So they're projecting growth in Detroit. You can see it's green. And they're projecting out through 22. So at least Fales is saying, hey, listen, this is going to be a hotbed of activity. We take a look at architectural billings. It's a leading indicator. This is an AIA document. You can see in the Midwest, 52.5. So anything above 50 is positive growth. And we went further, and you're going to see we did a survey, and I'll show you that in a minute. This is construction employment in the United States. And you can see Michigan is one of the leading states. Detroit plus 10%. And now I noticed I checked the AGC numbers just last month, and they actually went down a little bit, but we're going into winter. So, but still very positive. And of course, we're going to talk a little bit about labor shortages because that's really what we're facing, especially in Southeast Michigan. So we did a little study here. We kind of added up all the different kind of locus of economic activity. And you can see here, we're showing $8 billion in the region through 2020. Now, this is actual construction activity. Now, the key here for us in projecting construction cost is how much of this work is actually going to go ahead. As you know, capital projects sometimes get delayed. They get kicked down the road. There's a lot of different reasons why that happens. But for me, in trying to project costs, it's really going to depend on how many of these projects go forward per schedule, based on their schedule. So we're seeing tremendous activity in Southeast Michigan, and we think that's going to continue. There's talk, and I know you've all been looking at the papers, but the University of Michigan forecast that came out just recently, it was in the Free Press recently. They're saying, look, we're not going into recession yet. You know, it's at least for the next 2 years, but we are projecting a slowdown. I think everybody is. But the next couple of years, because we're kind of a lagging indicator, construction, right? We see it as being extremely strong. And like I said, we're going to be facing some labor shortages. One of the things we're seeing in Detroit is the transformational brownfield plan, TBP. You know, and you can see it being utilized here. This is a state fund. You know, Bedrock's taking a big advantage of that fund, for example. And there's other funds, as you all know, brownfield plans that incentivize construction that many owners are taking advantage of. Let's take a look at some of these indicators. You know, I talked about oil. I think what the good news is on construction, one of the things that keeps me up at night is, are we going to price ourselves out of the market? Is the cost of construction going to grow so high that a lot of these projects don't occur, even projects that are on the board, right? So our leadership actually brainstormed the other day ways to reduce capital costs, and we got really creative, got the whiteboard out, and went to it, because that's a very important concern. But some good news with crude oil, with the United States producing so much of it, it looks like that cost is being kept lower. If you look at it, I think some of the reports where it's gone down, but I went back and checked, it's about equal to where it was 1 year ago. So at least it's not increasing. And of course, I talked about the cost of the dollar, which is all over the place, but generally pretty strong. Let's take a look at some other materials. You can see here the shaded area is the forecast. And you can see 2019, 20, and 21. For cement, it's forecasted to go up. What's interesting is structural steel, and I see Cassaday Steel is here. We saw some tremendous increases last year. And people say, well, you know, what caused all that? Well, the demand curve caused it, but also Trump's tariffs had an impact, right? So we saw tremendous increases in structural steel, but it's projected to actually go down in 19. And I can tell you that in October we saw a mill price of steel actually go down for the first month since 2017. And for me, that's a big leading indicator of where the market's going to go. Softwood lumber, we saw it go up tremendously. Part of that was housing demand. And also, I think some of the storms actually had an impact on lumber. But you can see they're projected to be going down in the next year or two. I like this slide because it kind of shows you the impact over the last year of all these materials. Look at this. This is unbelievable. Steel mill products up. We had tariffs on aluminum too, if you recall. I mean, look at those numbers. Those are pretty dramatic. But here's the thing, though. If you look at these and you say, okay, that means the cost of construction went up that high. These are material costs only, and I mentioned roughly half are material and equipment, right? If you look at mill steel, for example, what I'll call in-place construction costs for steel, and a lot of our buildings are constructed with steel frames, you're seeing probably 4 to 5% increase since last year. Let's say year over year. That's it. It's It's pretty dramatic. I mean, an owner is not going to be happy about that, but at the same time, it's not 25%. You can see construction wages are going up, and Jim Lake's going to talk about that in a minute. The one thing that everybody points out to me is the architectural services. Somehow architects aren't taking advantage of this economy. I'm not exactly sure why. All right, so I want to show you a survey we did of the top 20 architectural firms in Detroit. And so we did this directly, and Mary Lefevre helped me put this together. Let's go right into it. How did 2017 billings compare with 16? You can see that the majority are saying slightly higher, and 22% say significantly higher. So this is very positive. How do you currently view the local economy? Look at this. Steady growth, 87.5%. So this is we're focusing in on Southeast Michigan, on Detroit. What is your revenue forecast for 18 in comparison to 17? So look at this. Significantly higher and slightly higher, probably 3/4 of the people we surveyed. Pretty dramatic. What is your percentage of work in Southeast Michigan? We just wanted to make sure that some of the larger firms who do a lot of work outstate weren't projecting outstate data. But you can see here the majority are focused here in the Detroit area. This is a great one, and to me this tells it all, right? Yeah. Do you plan to increase staff in the next 12 months? Everybody. So everybody's looking for people. That's kind of interesting. And I can tell you that in terms of the trades, we are in great need of tradespersons to build these buildings. I mean, we're woefully short of people. And if a lot of those projects that I showed up there move forward, it's going to be a real problem. Now, one of the questions, I'm going to anticipate a question. If you're building a building, what does that mean to construction costs? Well, it's going to mean the construction cost is going to go up. There's no question about it, because we're going to be competing for labor, right, between projects. And that gets kind of interesting, all right? So Jim's going to talk about that a little bit more. All right, I just wanted to show you in terms of labor, this slide is pretty interesting. On the left-hand side, you see the peak in 2000. And you see where we are today. We have not even reached that peak. We're 16% under that peak. So what that tells me is, yes, these labor shortages that we're projecting are in fact real. If you take a look at the right-hand side, the U.S. average increase in employment, construction employment, 4.3%. Look at Michigan. We're sixth in the United States in terms of adding construction workers. So we have a big challenge ahead of us in our industry. So what does it mean? I think, in summary, I just want to say this, that this economy in Detroit is going to stay very strong, certainly for the next couple of years in terms of construction. We are seeing upward pressure on construction costs for capital projects. There's no question about that. We project 5.25% for last year. Right now, I can tell you in tracking it, we're at the end of the year, we're probably going to be closer to 5%. And by the way, I can tell you the University of Michigan adopted 5% as well for their capital projects. For next year, we're actually projecting a little bit higher. We're saying more like 5.5% in terms of escalation. So that's the direct cost of construction from the beginning of the year to the end of the year. And a lot of people I meet, even clients, don't realize the impact of these inflationary pressures that we're seeing. I can tell you, for a large capital project, let's say a new hospital, if that project is delayed 1 year, we're talking about increased cost of about $15 million, let's say, for a new hospital. $15 million, and that doesn't even account for the revenue that the hospital could have achieved, being in place a year earlier. So these are significant dollars that we're dealing with here. So we're going to continue, to analyze and try to figure out ways to reduce construction costs. And just to give you an idea, we're looking at things like prefabrication and off-site prefabrication, modularization, so that we can reduce the construction period over time, and things like that. So, Mr. Like, I'm going to turn it over to Jim. Right. He did a deeper dive into our labor market here in Michigan.
Push that.
Sure, yes.
I don't know if it's for you or him.
Yeah.
But what about robotics and automation? I mean, how is that impacting some of these factors, in particular labor?
Yeah, so one thing I can tell you is that we are pushing prefabrication, robotics. I mean, we've utilized, for example, a robot to install brick. In fact, on the University of Michigan project. Yeah. We're seeing some gains, but it's not the type of gains that we really need to see. It's not insignificant, but it's not problems. It's not solving the problem that we're facing, in the marketplace. I think, though, we're going to be seeing more and more of prefabrication, where you're building basically a kit of parts. A building is going to be a kit of parts eventually, by the way, and it's going to be built in a factory. I mean, ultimately, maybe not in our lifetimes, but coming up, and there are examples of that in the marketplace right now. But eventually, the buildings are going to be built with all the elements in it, right? The piping, the electrical, and then it's going to be shipped out to the site, and boom, 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 you're going to have a building erected in 17 days or something like that, right? That's happening now, and it's going to continue to happen. We haven't seen an adoption of that very much here in Detroit. Now, we have 8 offices. If you go down to Dallas-Fort Worth, in Texas, you see an adoption of off-site prefabrication, which I think has actually had a significant lowering of capital construction costs down there. But here in the Detroit area, we're still kind of evolving there. So, did that answer your question? Okay.
Great. Thanks, Anthony. I want to talk a little bit about labor resources. Half of our projects, the money is spent on labor. So I'm going to touch on a few items here. The first thing is our employees are the union members. So they're one and the same. And sometimes we have to remind the unions that their members are our employees. I want to look at wages, talk about them a little bit, talk about pensions, health and welfare funds, wage package increases, the right to work laws, and where's our labor going to come from? So the building trades typically negotiate collectively bargained agreements. A bunch of contractors get together, we meet with the unions, and we bargain for wages and language, and try to get multi-year agreements. A lot of factors go into this: market conditions, cost of living, old language that we want to revise, get it updated a little bit, needs of the pension funds, needs of health and welfare funds. Wages are typically different based on where you are in the state. Detroit's a little more expensive than Lansing. Lansing is a little more expensive than Grand Rapids. As you move west, the wages go down a little bit. Some of the pension funds are the same, some are different. Health and welfare funds, some are statewide, some are localized. So I'll give you a typical wage rate breakdown. So what we bargain is the bottom line, the $60.61. But we have to look at everything. There's the base wage. There's some assessments, money that goes back to the union that's taken out of the members' taxable wage. We carve out money for health and welfare. We carve out money for a pension, some for an annuity. In this case, this is the carpenters in Detroit. And then there's a couple of nickel and dime funds that I show at the end there that don't really amount to anything. but it's a $60 package. And that's what we talk about all the time. So unlike our salary employees where we worry about the benefits and we have a health and healthcare plan, Blue Cross, whatever it might be, we have a 401k, maybe a profit sharing plan. With the building trades, we send the money out. It's managed by somebody else. There's health and welfare trustees that manage the health and welfare fund. Same with the pension fund. So if you look at I grabbed a bunch of the trades. The carpenters, they've got a lot of apprentices. You can see the rates are, from $60 to $43. 43 is the outstate cement masons. That's at lower wage as you move a little bit west. The contracts are typically 2 to 3 years. And if you look at the increases from 17 to 19, I started negotiating with the unions back in the mid-'80s, and it's always been 2 to 3% increase per year. Still holds true, and I think that was reflected in one of your slides, Anthony, as well. The pension trust funds. So when I talk about negotiating the wage rates, we take that $60 wage and we negotiate a percentage increase, $1. Then we have to figure out how to allocate that dollar. Part of it goes into the pension fund. So as you see up here, the pension funds are monitored. There's trustees on that pension fund, equal number of management and union trustees. We have quarterly meetings on this. There's assumptions made. The money's invested for the retirees. There's an actuary that works on life expectancy. There's investment returns. Any increases to the pension that are necessary to fund it are coming out of that total negotiated package. As a pension trustee, we look at the breakdown into age groups so that we can project when people are going to retire. There's money managers, there's lawyers, there's money managers watching the money managers. So these are really long meetings that we have. One of the challenges we have, though, is people are living longer. And I'm going to go back to the negotiating a gross increase. We have to figure out where to take that dollar and how to get it invested the best way. So I look at health and welfare costs. Those are always rising. So out of that dollar that I'm going to give the guys, I have to take some money for health and welfare fund. Pension, people are living longer. They're collecting longer. The stock market hurts us and helps us. Increasing man hours definitely helps us. But it seems that we always need money for pensions. So first we carve out for health and welfare, then we throw some money at the pensions. What's left goes to the base rate. And the guys really haven't seen a substantial raise in their base rate. I think the carpenters in Lansing this past June got a 10-cent raise on their taxable rate. That's really difficult. It's hard to look at the guys and say, did you work less hard this year than you did the year prior? If I take a snapshot of the pension funds, we use colors to code them. Green is good, red is bad, yellow is something that we have to watch. So we look at the makeup of the union. Detroit Carpenters are critical status. The pension fund is 38% funded. So they've got 19,000 participants total, 5,200 active workers, 7,200 retirees. There's more retired people than there are active employees. That's why we're having a problem. With the increase in work, that's great. Man hours are not going to solve all our problems to make it a healthy fund. The stock market doing well, that's not going to help either. As we look at the other unions, Gary, you've been living this a long time with the iron workers. They're critical status as well, but they're better than the carpenters. Some of them are 76, 77%. That's pretty good. We're happy with that. And there's a lot that are in green status. And then for anybody that signs agreements, we have pension liability, which is not good. This was something that was taken out of a letter that one of the unions sent to all their membership. They're critical and declining, and based on reasonable assumption, the plan's going to be insolvent within the next 20 years. So there's the pension fund. Here's this agreement that we signed a long time ago, and we agree to pay the wages and a contribution, and we end up with an unfunded liability. You know, if the fund runs out of money, it comes back to us. I can tell you that our unfunded liability is in the tens of millions of dollars. It's enough to make you sick to your stomach. And then to add to that, you know, if we go to the bank and if we put $100 in the bank account, we know that the FDIC is going to guarantee our $100 in case the bank has a problem. Well, with pension funds, we have the PBGC, Pension Benefit Guarantee Corporation. So they backstop pension plans. If the pension plan goes bust, no problem. The PBGC will jump in there and pick up the pieces. What nobody really realizes sometimes, though, is the details are more important than anything else. We've got a lot of retirees, guys that have worked hard their whole lives, whether they're electricians, carpenters, laborers, operators, and they get somewhere between $3,000 and, say, $8,000 a month in a pension benefit once they retire. The PBGC has a maximum payout of about $1,000 a month. So if the pension plan goes bust and if the PBGC has to step in there, the guys are only going to get a fraction of what they were really getting. It's not a comforting position to be in. Then I was reading online this week, and we can talk about assets and liabilities. So if you look at the PBGC, their liabilities are in the range of $67 billion. And their assets are about $2.3 billion. There's another comforting thought for us. So there's a lot of larger pension funds like the Teamsters. If the Teamsters Central State Pension Fund goes down, that could just take out the Pension Benefit Guarantee Corporation altogether. So we sleep good at night. So the real question is, where are the trades coming from? You know, when I need people, I call the hall, the union hall. They have an out-of-work list. They can refer people to me. We collect people from helmets to hard hats. We're trying to recruit veterans into the programs. So there's adjoining locals. Our guys are typically called journeymen. They'll journey from site to site. So I can get Detroit guys to go to Lansing. I can get Lansing guys to come to Detroit. I can get Toledo guys to come up here if there's a lot of work. That's where we're getting them from. We have apprentices every year graduating. We have open shop non-union employers that have a lot of people. We try to grab those people. We steal them from other contractors. We pay over scale if we have to. Easiest way to grab somebody. The adjoining states. And the unions do keep track of the numbers for the most part. Apprentices. Where do the apprentices come from? Friends and families. My kids went into the medical field. I wonder why. International Workforce Expo. If you hit the Detroit Free Press or the Detroit News, Bedrock, Bart Mallow, Turner are still advertising for a expo that was on November 14th. So trying to get the word out, even though that's historical information, we're all trying to attract people into the building trades. We're having career fairs. They're going to high schools. There's trade shows. Contractors. We have people walk in the door all the time and want to learn about the construction industry. We try to grab them. The high schools have pre-apprentice programs. The unions are out there organizing, and as I just said, the walk-in applications. So that's a little taste of our world in labor. Yes?
What does the government act with this in terms of...
pension reform?
Well, not pension
okay.
reform, but labor. I mean, you know, it used to be that people flooded into the country at harvest time, and I know H-1Bs are down, and, you know, it's not a good subject, but...
Correct.
I mean, in other parts of the world, there got to be a lot of these people who are just sitting around.
That's a great question, and I wish I had an answer for that. Our I don't know, to be honest. I don't know. I know the government is working on pension reform. That's a slow-moving task because we have to change laws and able to do that. I know that the carpenters got together with the AGC of America, and they looked at what would actually work in terms of pension plans. We know that if the PBGC picks up the slack on the pension funds, that's not a good solution. So what the carpenters looked at is said, with all these retirees out there, what if we compromise their payment? When somebody retires, there's a promise made. You retire, I'm going to give you X amount of dollars for the rest of your lives. So the carpenters asked the question, what happens if we compromise that? If we say, we're going to give you 80% of that promise. Well, working with the actuaries, what that actually does is that really extends the funding period and really helps out the plan. But it's not legal. So then you start going backwards and trying to change the pension laws to really get behind a program that the unions can support and the employers can support. So we're working on various areas, but I know that the visas, just trying to get people into the country is a challenge. It's highly political right now, but I know myself, I had a intern that was Indian. Great, got a master's degree from Western and is going through this whole H-1 visa process. It's a horrible process. It's a lottery. It's a wild card, and it's a great kid. I want to keep him, and we're just challenged all the time with that. And as far as getting more tradesmen in, it's a challenge. For the longest time, people have been talking about, what do you do after high school? You go to college. Get your college degree. Nobody talks about going into the trades. Yeah, and correct, they are now.
It's too late.
Yeah. My grandfather was a tradesman.
They needed machinists.
Mm-hmm.
This has been a canary in the coal mine for a long time.
It has. I was just going to say, my grandfather was a tradesman. My father was a tradesman. My grandfather was the one that said, no, go to school, go to school. So I'm actually an engineer. But now we're trying to get back with the schools and get the kids interested in the vocation. And tradesmen can make good money. We have a lot of guys that make, $60,000 to $100,000. Show up at 7, go home at 3:30. Sometimes I'm kind of jealous.
Just wanted to comment. I read yesterday where I think it was Goodlot was proposing doubling the number of H-1B visa candidates. And I can tell you that I believe that with the H-1B, they can work in the United States, I believe, for 6 years, a 6-year period. So I think they're starting to think that way.
Another question.
Jim, this might be for you and Tony. If we look at the Gordie Howe Bridge, and the estimates I read is that that's going to require 10,000 people. I think for the most part still work with you for 3 to 5 years. Have you looked at that project specifically and considered it in the context of other major projects that will require the same skills, the same scale, the same work? Are there enough bodies to do what we need to do? Because obviously the bridge is going to suck a lot of that down for a long time.
Go ahead, Anthony. You want to jump on that one first?
Let me take that. It's on the horizon, but I got to tell you, in terms of the impact on our industry, which is basically non-residential, buildings. A lot of the trades are different, on the bridge. You don't have finished trades except for in some of the facilities. So we didn't factor it in as a major impact. Any comment? I guess the steel is a big part of it. But I mean, can you comment from Cassidy?
Our understanding that most of that specialized is not your typical structural.
Yeah, that's where we're coming from. Yeah.
There are some outlying buildings and facilities that will be associated with.
Well, and I'm going to add my commentary to that too. I can go back about 15 years sitting in labor negotiations and having the union tell me that the economy is so great we're going to build a new bridge. We've talked about this bridge for years and years and years. And I'm a building guy, so I look at the bridge and say, okay, there's a bunch of steel and one foundation. You know, I'm not really concerned about it. But there will be assorted other areas, you know, support facilities around that. And then we really break down our labor into various categories too. We're a commercial building company, so we have building agreements, and the road work and the bridges are typically under MITA, infrastructure agreements. So it's the same unions, but different wage packages and different members. And the other thing is, you know, we talk about projects that come up all the time, the Hudson's building, the bridge, some of the things that Bedrock is doing, the Monroe block. And these projects always push. So what do we have in front of us? You know, is the bridge actually going to happen? And I think we're there now. But, you know, a lot of these projects that we try to gear up, and the key to our success is having a consistent workforce. But at the same time, every time we get a job, we spend hours and we're looking for the next job. We joke that we're 3 months from going out of business at any point in time. You know, we get a project, we eat it up, we're looking for the next project. It's a real challenge for us. All right, Mary, I'll hand it back to you. Thank you.
There's a question.
What's the green movement going to do to our cost on building costs?
Oh, the green.
What are the tax advantages to that?
Yeah, you know, overall, in terms of, so specifically the cost of construction, right?
The cost.
So, you know, we've been building sustainable buildings now, and it's really kind of ingrained in architecture in the United States, at least, right? Because of the U.S. Green Building Council. So a lot of that has already been kind of baked into the, you know, how we build buildings today. So really, it's, you know, the cost of green construction has actually gone down because it's become pretty standard. So a lot of owners, our clients, are not going for certifications, you know, let's say a LEED Gold or whatever, right? But their buildings are very sustainable, and they're very concerned about lowering O&M costs, and we're doing that. So we're seeing really great trends in terms of sustainability. You know, so I don't know if I answered that question.
Energy conservation too.
Oh yeah. So I mean, our buildings, I mean, you look at lighting systems right now, and you look at really high efficiency heating and cooling systems. I mean, the cost of, you know, owning and operating a building has come down. We just completed a major project in Lansing with underfloor air, and the idea was to reduce the energy cost for this pretty large facility. And when I walked through, the client stopped me and he said, "We are actually saving more than we thought we were going to save." You know, we had done a life cycle analysis for that client, and they went on and on about it. So we're seeing some really good things in the United States, I mean, in my opinion.
All right, so if there's one thing for certain is that in construction, you can count on there always being change and uncertainty. So we'd kind of like to finish right now with talking a little bit about the projects that Chrisman has under contract or will soon be under contract. And then those will be opportunities for a lot of the folks in the audience. We have a lot of trade partners here, so I'm excited to tell you about these. So at the University of Michigan, we're working on a project for a new central power plant and a switchgear upgrade. It's about a $73 million project right in the heart of the central campus that will start construction, I believe, in March of next year.
You know, if I may piggyback on that, here the University of Michigan is building a combined heat and power plant. So it's a gas-fired turbine. And what they're doing there is they're going to be shedding load with the utility. So that's kind of an interesting thing. I mean, they're going to be able to generate electricity for less cost than and more efficiently than the utility itself. So I think the regions just decided, hey, we want one of those, and they decided to build one. So it's the latest technology.
And maybe a trend for future universities to
Yeah,
look
you're seeing it at other
hospitals
universities as well. Yeah.
Other large campuses that are huge consumers of energy. We are in pre-construction right now for an office building out in Line Township. That's for Zeiss. They are an optics company out of Germany. We'll be mobilizing our trailers on that site probably in the next 4 to 6 weeks. We're under contract for a new veterans home up in Chesterfield Township in Macomb County. And this is a $50 million project that's funded from the Veterans Affairs, the federal government, and also the state of Michigan, DTMB. And this project, we had a ceremonial groundbreaking right before election earlier this month. And we will be under construction with that starting first quarter, second quarter next year. And we're doing the same exact project over in Grand Rapids. So it's really great news for our veterans and long overdue. We're working with the University of Michigan right now on a P3 project. It's a public-private partnership project. And we'll stay tuned on that one. We're looking for the Board of Regents to approve it hopefully next week. And it's a pretty substantial project. So as I said, stay tuned. We are working with ODM on a project for, it's a mixed-use office building, and the DMC is a major tenant. This is a Sports Medicine Institute that's actually going to go right in between the Little Caesars Arena and the Mike Ellis School of Business. So there's a little piece of property there where that is going to go. And then we've been, honored and privileged to be selected as the construction manager for the Michigan Central Station. We're in partnership with Alice Brinker on that. We will have outreach programs for our trade contractors early next year. This will be under the executive orders for the city, and we'll be getting construction underway probably mid next year. And as I say, that's a wrap. So we can open up to more questions. Yes?
You said P3 would do that. Who's that? Those three partners?
So it's a public-private partnership. So it's University of Michigan with the developer, with the private developer.
Going with your charts, and one of your first ones, you say the arrow's going for another 3-4 years up. But you also acknowledge a lot of people are talking about 2020. It's starting to change. Again, yours keeps going up. How are you correlating those two things together, or is it just not yet in there in the future? Because then going into the latter part that I brought up was the labor union right now, like Local 58's got 90 apprentices not working and 400 guys not working. So they don't want to keep taking in guys, even though next year we're going to get down to zero employment, because everybody remembers 6 years ago. So they don't want to have 1,000 guys sitting on the book in 2021 and 2022. So coordinating the scheduling of projects, and I believe your first chart says 4 years.
Yeah, I just want to point out that was Fails Management Institute, FMI. So, no, I don't think that's correct. I think they showed that line going straight up, right, over the next 4 years. We don't expect that. We think, well, first of all, we think the economy is slowing, right, overall. I'm focusing in on construction, right? So we have enough momentum and volume and projects on the board, even if some of them don't go, for the very strong next 2 years. But I can tell you this, at the Chrisman Company, we're planning on an economic downturn that we're going to see, probably after 2 years, at least in the city of Detroit. In other areas of the country, you might see it before that, So, yeah, I'm glad you pointed that out, because that graph did make me uncomfortable. Yeah.
Because otherwise we're going to get to zero unemployment in every trade, and then you're going to go back to a bad situation.
Yeah. Yeah, good point.
Yeah.
Thanks so much.
There's a question in the back there. Yeah.
Yes, I was over at the train station back in August, and I assume it seems you specialize in historical rehab. You'll be doing most of that, or
in the train station?
Right.
Yes, I mean, it will go for historic tax credits. The plan is to go for the federal tax credits for that. So yes, it is a rehabilitation, hopefully back to its original grandeur, if you will.
Do you have any further information on that, like as far as on your website for doing this project?
We don't yet. As I mentioned, we will have an outreach, probably a couple of outreach programs for our trade contractors when we'll go over the schedule and when bid packages are going to be coming out and all the details for that. But it's not quite there yet on the website.
Okay. Thank you.
If I can add to that, it's going to be a very slow process. If you've actually been inside the building, there's quite a few challenges there. The first one is to make it watertight. And then we have to make sure that it's actually safe so the architects and engineers can actually get up and look at some of the intricacies to the building. The outside facade is weathered very bad. If you go inside the front doors, there's Gustavino tile and there's an interstitial space. We have to get in there between the tile and the roof to do inspections. So there's going to be a whole lot of nothing happening for 6 months that you'll actually see. So.
One more, guys. Jim, I think this would be for you. I'm curious what your thoughts are on the prevailing wage change this year.
Good question.
I think it's a challenge, all right? Right now, there's a survey out there right now to establish the prevailing wage. And I'm a union contractor. I've always been a union contractor. So the prevailing wages were typically set by union scale. They would just look at what the union rates were, and that was the prevailing wage. Now that the laws have changed, there's some real challenges out there. If anybody drives along 696, you know we had an issue with the operating engineers and the work stoppage out there. And prevailing wage rolls right into that one too, because the union agreement expired on June 1st. So they continued to work. There were pension contributions made, the wages were paid, but because there was no contract in place, the pension fund could not accept the payments, so they sent them back to the contractors. The road work is prevailing wage work, so suddenly the contractors are not compliant with the prevailing wage. And of course the union is promising them, that the employers are going to pay your wage, they're going to put all your benefits on your check, you're going to get that, and then we're going to negotiate a package that's retroactive and you're going to get a huge bonus because they're going to pay all your benefits again. That's a nightmare coming true. I don't know where the prevailing wage is going to end up. It's a wild card right now. So.
Thank you very much.
I told you that second half was going to be something else, didn't I? Wasn't that great? I just wanted a couple last minute items here. Again, we want to reiterate about the CPE. If you want it and need it, it's in the front. Please tear out the feedback sheet in the back and fill in the comments. We really appreciate those. And you can drop them off at the table in the front as you exit. Look for our email that's going to give you some links to get the slides along with the video of this presentation today. And that's it. Look forward to registering for next year, for 2019. So I personally want to thank all our outside speakers, non-UHY speakers, for coming in today. I really appreciate it. I thought they were great. So I want to thank Jessica from my UHY marketing team. She helps me along throughout the whole year, and this can't even happen if it wasn't for her. So thanks, Jess. And thank you for coming. Obviously, this is why we put it on. It's for all you, for education. And like I said, I see so many faces from the past and new faces, and I really appreciate it. So I hope you enjoyed it today. Thanks so much.